Ambition is too precious to be bottled up, too powerful to be kept on the bench. It's the magic potion, your secret weapon. It wakes you up in the morning and keeps you awake at night. So why hold back? Unshackle it. Let it fly. Let it dance. Let it bring the rain. Let ambition fuel your next chapter. And let HSBC be your partner in this journey. With our knowledge, our network, our experience, we've seen ambition bear fruit again and again across the world. Connect with us. Ambition is too precious to be bottled up, too powerful to be kept on the bench. It's the magic potion, your secret weapon. It wakes you up in the morning and keeps you awake at night. So why hold back? Unshackle it. Let it fly. Let it dance. Let it bring the rain. Let ambition fuel your next chapter. And let HSBC be your partner in this journey. With our knowledge, our network, our experience, we've seen ambition bear fruit again and again across the world. Connect with us.
Good afternoon, ladies and gentlemen. Everybody is requested to get settled. We are starting in 2 minutes.
Ambition is too precious to be bottled up, too powerful to be kept on the bench. It's the magic potion, your secret weapon. It wakes you up in the morning and keeps you awake at night. So why hold back? Unshackle it. Let it fly. Let ambition fuel your next chapter. And let HSBC be your partner in this journey. With our knowledge, our network, our experience, we've seen ambition bear fruit again and again across the world. Connect with us.
Good afternoon, ladies and gentlemen. I am Manali Shah, and I welcome you all to the HSBC IFSCA Global Wealth Summit, a congregation of innovative ideas setting the stage for the future of global wealth management in India. And what other venue to host this dialogue than at Gift City, India's gateway to the world of international financial services. In a world where markets move faster than ever, where borders blur in the pursuit of opportunities, and where wealth is no longer just about how you earn it, but also how you protect it and invest it. Staying ahead is everything. Today, we shall be navigating some of the questions which are defining the global nature of wealth in today's connected universe. How is Gift City transforming global wealth management? What does rethinking life insurance mean for the global Indian? And how can you stay ahead in a world where financial landscapes evolve by the second? Over the course of this afternoon, you'll hear from industry pioneers and thought leaders, people shaping the next era of wealth creation, innovation, and protection. And as the world watches how India is redefining its place in the global financial ecosystem, this summit is your front row seat to the future. This is where the conversation starts. And now, ladies and gentlemen, to set the stage, I would like to invite on stage Mr. Sandip Batra, MD and Head, International Wealth and Premier Banking India from HSBC to deliver the keynote address. Come on, everybody, please join me in welcoming him.
Thank you so much, and truly grateful, I think, as HSBC to get this opportunity. It is not every day that you have the regulator, you have the industry players, you have customers, all in the same room. So delighted, Chairman, sir, that you could make it and for spending time with us. I think HSBC in India has been there for a long, long time. For those of you who do not know, we've been around 170 years in India. That's 10 years longer than our parent itself. The parent started 160 years back in Hong Kong and in the UK. We acquired Mercantile Bank, which had started even 10 years earlier. So we've been there really a long time, right? But we actually honestly do feel that we are constantly starting up, constantly growing. And initiatives like GIFT remind us of the need to be starting all over again on a constant basis. Just last month, we celebrated 100 years of a Calcutta branch. That was celebrating legacy. Today is actually about celebrating the future. Personally, I was a NRI for about 18 years. 3 years back, I came back to India. I think I was an NRI, then I became a resident, but not ordinary resident. From 1st of April, I become ordinary resident. And honestly, but my lifestyle has not changed. I was looking at investment opportunities globally when I was around the world. I was always interested in the wonderful, beautiful investment markets in India. When I wanted to buy insurance, I wanted to buy here in India and around the world. And even now, when I've come back to India, my son may go to study overseas or may not go to study overseas, but I have assets here, I have assets outside, and I'm constantly thinking, how do I protect my money? How do I grow my money? And that is not true just for me. That is true for the 32 million diaspora who's around the world. And as Indians get more and more global, 800,000 of us go to study or go to work or go to live around the world, they will need access to global finance. And I think this particular place at Gift City, I think we have the opportunity to make a single account, right? Traditionally, we were used to having an Indian resident account, then convert to NRE, NRO, then open the dollar account overseas, then come back and convert it again. I think at Gift City, the global Indian should need only one account number. That account number should be your multi-currency wallet. It should be your ability to invest in India, ability to invest overseas. You want to buy life insurance, you want to buy general insurance, I think you should be able to do that right here. So that is something the global Indian should be able to carry around the world. As India becomes larger, as we become the third largest economy and hopefully even larger than that, that is, I think, what we are looking to enable. I think the teams have already done a lot of work with the guidance of the regulator. We have started to open bank accounts here. The bank accounts are live. The term deposits are live. Our joint venture Canara HSBC, which is here today, they already have the license. They will start issuing life insurance policy. We have wonderful partners from asset management companies. They have both kind of products, inbound for NRIs who are looking to get access to India, as well as outbound for Indians looking to seek global investment opportunities outside. So delighted to welcome you all. I think our focus as HSBC India is an absolute top priority market. We were redefined as a top 4 market in the world recently by a global board and a global CEO. So clearly investing, we just got a license to enter 20 more cities in India. Traditionally, we were in 14 cities in India. We just got the approval to get to 20 more cities. So we want to take this globality, we want to take this ethos across the country. We'll continue to invest, continue to bank. So delighted, and let's let the conversation begin. Thank you so much.
Thank you so much, Mr. Batra, for that thought-provoking and inspiring address. I would now like to call Mr. Ashish Tripathi on stage, who is the CEO of HSBC Gift and has more than 2 decades of banking experience. He has worked in various roles and in multiple countries, including Singapore, Hong Kong, Malaysia, and India. He has an engineering degree in computer science and is IIM Ahmedabad alumnus. HSBC Gift City is the first bank to get license from IFSCA. In last 4 years, HSBC has launched more than 40 plus products, including loans, trade finance, payment solutions, and international wealth and premier banking. HSBC Gift also has foreign portfolio license and investment banking license. Ladies and gentlemen, please join me in welcoming Mr. Ashish Tripathi on stage.
Thank you so much. It is my honor and privilege to introduce and invite our next keynote speaker, K. Rajaraman sir, who has been the catalyst behind taking India's rapidly evolving financial ecosystem to the global stage to deliver. K. Rajaraman sir belongs to the 1989 batch of IAS and is chairperson of IFSCA. He has more than 35 years of experience in various leadership roles in Government of India and Government of Tamil Nadu. May I request Rajaraman sir on the stage, please. Thank you so much.
Mr. Batra, Mr. Ashish, and other friends from the HSBC, my colleagues, Dipesh, Pradeep, and others, distinguished invitees to this today's event. First of all, I would like to thank HSBC for having organized this conference, a very timely and important conference, given that the Gift City ecosystem has been evolving over a period of time. I mean, all of you are aware that about the growth story of India. I mean, I think as all of us Indians, we have been watching very avidly about the progress that it has made over the last 3.5 to 4 decades after the launch of the liberalization process, and more so in the last 10 years, when a lot of reforms have happened in the financial sector. To me, some of the most important reforms that have happened in the last decade or so have been very fundamental in nature. The first one being the management of inflation within the country. The flexible inflation targeting regime which the Government of India has initiated in the form of an agreement with the central bank has enabled focus on inflation control, which I think is a very important thing for a developing country like India. This has actually reinforced and strengthened the trust and confidence of investors, both domestic and foreign, in the Indian markets. Similarly, I think many other structural reforms like goods and services tax, which converted a fractured domestic market into a single consumption market, has been a phenomenal success. And of course, I think people avidly look forward to the next generation of reforms in GST, which the Honorable Finance Minister has announced in this budget. The direct tax reforms also have been very remarkable. Corporate tax rate was cut in 2019, and after that, the number of filers have increased significantly. The tax payments have increased significantly. All of them point to a fairly good state of formalization of the economy. Both GST and the direct tax reforms have actually contributed to the formalization of the economy, which I think bodes well for the growth going forward. The financial sector reforms in the banking sector have also been phenomenal in the sense that today, thanks to the Insolvency and Bankruptcy Code, coupled with the asset classification and provisioning norms introduced by the Reserve Bank of India in the last 7-8 years, as well as consolidation of public sector banks into stronger, bigger, lesser number of banks, have actually led to a greater amount of discipline in the corporate world. Today, corporates do not go to the banks unnecessarily, and many of them have deleveraged, and enabling the banking sector to actually cut the losses and also move towards profit. Today, all the banks are profitable, and in fact, they are doing extremely well, and this is the case of insurance companies as well. The total non-performing assets in the banking system has actually dropped from about nearly 13% to about 3% of the book. So, which means that they have done a phenomenal. The IBC has been a great success. If you look at the outcomes, we expect that probably these first-generation reforms to actually to improve over a period of time. The Government of India has also focused entirely on the ease of doing business to ensure that the business community gets the confidence to put increasing sums of money on the market in more and more sectors. With all these reforms, I think one of the most important reforms have been the capital market reforms, which has enabled the retail investors to come into the market in a very, very big way. Though I think all these reforms are work in progress, the proof of the results of the first stage of capital market reforms are here to see, with the number of retail investors, retail trading accounts, which used to be about 40 million in 2014, having gone up to nearly about 190 million just as last month. So what we will see going forward is that number of participants in the formal financial ecosystem will gallop, I think, especially with the launch of the Prime Minister's Jan Dhan Yojana, where about 540 million people who never had bank accounts have now been connected to the formal banking system with the bank accounts. So we'll see the bottom of the pyramid and the middle class playing a greater role in the progress of the economy. The Honorable Prime Minister's vision going forward has been enunciated through the idea of Vikasit Bharat at 2047, which is a very bold statement to make India a developed country by 2047. A lot of foundational work is going on in all the various ministries, other stakeholders in the industry, and in the financial and in the non-financial sector as well. If you look at the reform process, I think the process is far from complete. The replacement of the old legal architecture with a set of modern laws is under progress, I think, as we speak. Every ministry is now introducing new bills in Parliament, which are replacing laws which are 50 years old and 100 years old with new laws which are business-friendly, forward-looking, progressive, and also technology-friendly, and so on and so forth. So we will see this happen in all the sectors in the next few years, and that this will actually significantly improve the way in which business is done in this country. The regulatory architecture is also out for a reform. The Honorable Prime Minister has announced a regulatory commission, deregulation commission, just a few weeks back, focused on deregulating the burden of regulation in the non-financial sector. The Honorable Finance Minister has announced a high-level committee to look at simplifying the regulations in the financial sector and in specific sectors like the pension sector, etc. So with all this, we expect that the business to become even more, agile and more interested in investing bigger sums of money in the longer term. One of the reforms that the Government of India has thought of doing in the last decade was the International Financial Services Center. So while the Indian reform process will continue, there are a few things which will take time for being fixed in India. I think one point is full convertibility in the capital account. This will take time, I mean, maybe several decades before we are ready to actually fix it completely. So till such time, I think, so this is one of the problems, I think. There are other problems like maybe the complexity of our tax regulations, which partly arise from the vulnerability of India to a variety of problems like money laundering, maybe things like round tripping and so on and so forth, which still is something which we continue to grapple with. So while we do all of that, the government felt that I think we cannot wait forever to get a world-class financial ecosystem. So the thought process was that why don't we create an enclave which instantly benchmarks itself with the rest of the world, I think. And that was what was achieved by setting up the Financial Center through the Act of Parliament in 2019. So the International Financial Services Centers Authority Act of 2019 delegated the powers of the domestic financial sector regulators under the 16 financial sector laws to a unified regulator called the International Financial Services Centers Authority, which, from which all of us come. So this unified authority has got jurisdiction over this special economic zone, which has been declared as a financial center, service center for the, with a focus on global operations. The last 5 years, what we have done is to write 31 new regulations and about 16 plus frameworks, which are completely benchmarked with the regulations that are obtained in the rest of the world. And finally, therefore, the proof of the pudding is in the eating. I think the progress that the jurisdiction has made in the form of, on what we have been able to do is proof that this has worked, I think, significantly, and we continue to further innovate and improvise on the regulations. Today, we have about 31 banks whose asset size has crossed $81 billion. And the banking ecosystem here, I think people like HSBC have actually built it up through a lot of hard work, I think. So this ecosystem is focused not only on corporate banking, but also on the retail markets as well. So while, today, most of the Indian corporates do not go to a place like Singapore or Dubai for raising a line of credit. They come to the GIFT City banks and they're able to raise those lines of credit, maybe $1 billion or several billions of dollars from banks like HSBC effortlessly and in a highly competitive manner. So this story was built up over a period of time with a number of products which have been launched by the GIFT City banks, which include trade finance and a variety of specialized finance for sectors like aviation and shipping and so on and so forth. We also see GIFT City banks venture into a variety of other roles, like serving as foreign portfolio investors services, FPIs for foreign investors. I think GIFT City banks are also writing overseas derivative instruments for foreign clients on Indian stocks, bonds, etc. And we also see them, I think I was just having a conversation on how HSBC is also in the process of becoming a corporate agent for insurance products. So eventually what we would like to see is that the GIFT City banks, the banks are the foundational element of a financial ecosystem. So we expect banks to become a one-stop shop for all the products, all the retail products that one can procure in a financial market. So be it a capital market product or an insurance product or a pension product or a deposit or any other kind of financial product or financial service, it should be possible for banks here to kind of bring them to the doorstep of the customer through a digital platform, enabling the customers sitting in San Francisco or in Dubai or any other part of the world to effortlessly access it at any point 24/7. So we have also directed the banks in GIFT City to ensure that their platforms have the full suite of services, including transactional banking on all these kinds of products. So enabling customers to access this any time of the day or week. Therefore, if you look at from a retail perspective, we have nearly $1 billion of deposits from various, in all the banks put together, from over 7,000 retail clients across the world, which I think is we have just touched the bottom of the iceberg, I would say, I think. So not the top, I think. So therefore, we have a long way to go. There are about 15 million non-resident Indians and about 19 million persons of Indian origin who live across the world, I think, who have abiding interest in India. So we believe that these 34 million people who live across the world have a great potential to save, invest, pension, insure, or themselves out of GIFT City. Similar, I think while I say that, while I'm talking about an inward theme, there is also a possibility of an outward theme. There are many resident Indians who have family foundations or they have a personal wealth which they would like to invest in the global capital markets. They are also finding ways and means to use the GIFT City banking ecosystem, as well as other structures like alternative investment funds, portfolio management service providers, etc., to invest in global capital markets. We have 2 stock exchanges which have done very well. I think, though of course they do not at this point of time sell Indian stocks. I think we hope that they will list Indian companies in some time from now, because a listing of unlisted Indian companies is possible. There is a possibility that they already very strong in derivatives market. The average turnover of derivatives in any given month is about anything between $85 to $100 billion in a month, and with an open interest of about $10 to $12 billion on any given day. So we see the products like GIFT Nifty 50, the Sensex building up their steam. The exchanges also have an outward theme. I think, in fact, India INX, one of the exchanges, has a global access system through which I think resident Indians can access the global markets and buy and sell stocks and other products in the international markets, as allowed for residents by the central bank. So I wouldn't want to go further, but I would only say that the corporates in India have the international global financial marketplace today at their doorstep. I think be it trade finance or corporate finance or specialized finance for a particular line of activity like shipping or aviation, etc., you can have it in GIFT City without an effort. Similarly, if it's a case of retail markets, today banks offered structured deposits. They offer a variety of other products as well, I think, which enable retail investors to invest in the stock markets. They also do other capital market services for clients. So I think we expect that the requirement of customers, I think, would be met by the banks, because all the banks, at least 15 banks are international banks, 15 of them are Indian banks. So the international banks have the experience across the world on what customers want from this jurisdiction. I will stop here and say that I think one of the important thrusts of GIFT City is also to become a major wealth management hub for private individuals, family foundations, as well as of companies which want to invest surplus capital in the Indian markets. So as of now, I think the family investment fund ecosystem is possible for inward investments. I think if there are families abroad which have got pools of capital, I think they can invest into India. There are no restrictions at all. I think we can support them. It can be global. They can invest in GIFT City in entities which can also invest outwards. I think so. The advantage of GIFT City is that I think the themes are flexible. I think you can use the platforms here and the structures here to invest in India as well as outside India as well. I think from the same structure. So therefore, from all these perspectives, the flexibility of doing wealth management out of GIFT City is certainly possible. At the same time, let me also assure you that I think we are a jurisdiction which wants to ensure that the integrity of the markets is not affected by any bad actors. So there is always a focus on anti-money laundering and counter-financing of terrorism. So those concerns are soundly taken care of by adoption of the AML and CFT guidelines under the PML Act. So we believe that there is a great opportunity for both individuals as well as corporates to grow their wealth and capital, and also the business ideas out of GIFT City. Finally, let me end by saying that it is just not a financial center. We have a variety of themes around which I think businesses can be built, which includes maybe things like aircraft leasing, ship leasing, maybe the bullion markets. The bullion market here is quite active. Just a year, I think the bullion exchange has actually done a trade of nearly about 100 tons. Of physical delivery, I think, out of GIFT City. They also have started delivery centers in Chennai as well, I think, and we hope that maybe in some time from now they will do so in many other important destinations in India as well. So with this, I will stop here and wish the conference all success and wish all of you a great journey if you consider investing here. Let me also say that we are building up our supervision and surveillance capabilities so that I think we ensure protection of investors under any circumstance. So this is also one of our most important role as a regulator. When we have an investor protection unit which has been set up and a compliance handling system which ensures that the regulated entities here, be it a bank or a fund, take their responsibilities very seriously and ensure that the rights of the investors and customers are upheld as per the law. So once again, thank you very much and Jai Hind.
Thank you so much, Chairman, sir, for insightful speech. May I request Mr. Sandip Batra to please come on stage and felicitate Chairman, sir. Thank you.
Thank you so much. Going forward, I would now like to call on stage Dr. Dipesh Shah to share his thoughts on growth of banking in GIFT. Dr. Dipesh Shah, he is the Executive Director at IFSCA and is responsible for the overall development of IFSC in India. He holds a doctorate degree and has over 23 years of professional experience in international business, project development, corporate affairs, corporate law, and policy matters. His achievement includes setting up and operationalizing India's first smart city and international financial services center and has been associated with the development of GIFT City since its inception, that is in 2008. In the last 16 years of his tenure at GIFT, GIFT has made substantial progress in getting recognition as India's model smart city and the only approved international financial services center. So ladies and gentlemen, please join me in welcoming Dr. Dipesh Shah on stage.
Good afternoon. I really appreciate the HSBC for taking this initiative because when we were reading the theme, Global Wealth Management Summit, I think the word global really caught attention of many of the people who were talking about the summit. And probably who better than Mr. Sandip leading this Global Wealth Summit because 18 years you were outside India, you made a lot of wealth, you came back to India and you are landing up into and developing the GIFT City as a global financial hub for your bank. I think it's a great initiative from the HSBC of putting this together. I was told that today a lot of high net worth individuals and the institutions are present and some of them may have traveled for the first time to GIFT City. Probably they are used to travel to some of the well-known financial centers outside, but probably traveling to a global financial center without visa has been your first experience. It is within the same country where you are living and you are just in 50 minutes. If you're coming from Bombay, you've been in GIFT and you are experiencing probably a new set of institutions, new set of way the financial services are being delivered. I think our chairman did highlight quite various areas, and what I've done is Ashish from HSBC, he told us that we'll be sending you the agenda of today's, and I always thought that there will be a presentation on the GIFT, but when I read in the morning, it's talk about the growth in the banking ecosystem in the IFSC. So I also tried to manage some of the data from the banking side and probably just manage in time to send him before the summit was started. But good that because of that, probably I also came across many of the new data points which normally we are not used to presenting. But I hope you will find some of the new data points interesting, because the way the banking ecosystem in IFFC is emerging for the wealth management is very, very exciting journey that we are seeing. I would probably draw your attention to two facts and two aspects. When you are coming to GIFT and when you are experiencing this new change, probably you would also like to see that what you as an individual or you as an institution, how can you contribute towards this journey? Because that is very important. You know, people on this side, the regulatory side, we can only talk and make regulations. We can't do anything. You know, it is you who can actually make this financial center grow from where it is and where it can go from here on. So I'll request all of you to probably look at the opportunities that you see and how you can utilize for your own institutions as you go back. Second, I think we've been becoming an experts in creating structures, and probably some of the consultants are also, I see here, they have always handholded you for tax treaty shopping across the globe. You know, they took you to Dubai, they took you to Mauritius, they were taking you to Singapore. Probably some of them are now also bringing you to GIFT, because they also find that this is equally important. And as you have seen your journey of growth in some of the financial centers outside, I think it is the right time for you to see that if you can grow and expand in your own financial center within Indian ecosystem with your own talent at an Indian cost with a better tax certainty, I don't think you need to probably look at some of the centers outside. Recently, when I was present here, where I was presenting some of this data and this type of opening statement, I did not realize there were people also present from the Monetary Authority of Singapore and the Dubai Financial Center Regulatory Authority also. So when I suggested, I said that, look, this is more collaboration. You know, how can our center connect with you more efficiently? So while on the one side, we always look at it as a competition, but I think on the other side, we look at probably an answer to how can you collaborate with other global financial centers more efficiently. With that in mind, I'm just taking you with few slides on the data points, as I said, which might be important for you to undergo. Yeah. So the photograph before which you saw was our headquarter building, which is coming up. When you entered the GIFT City, you would have seen this tower coming up. This is the IFFC Authorities headquarter coming up probably in October 2025. We will be shifting to this of our own office space. But you see, I think the journey of GIFT, and many of you probably today when you would have entered the GIFT, you would have find one thing for sure. You would have noticed a lot of activities, a lot of buildings coming up, a lot of constructions work going on. And some of you, and I was just, before entering this room, I was chatting, somebody told me that before 3 years, when I used to come in GIFT, there were 2 buildings, 5 buildings, and there were not much activity. And now when you come, you really find a lot of financial professionals across. You find difficulty in parking your cars, which is also a testimony of the growth of the financial center. And that's where we thought that we should run you with some of the data points. We were 129 firms, as we always present, that, this was when the 4 domestic regulators helped us to grow the financial center from bottom up. This could be probably a very challenging center that you have to, it's a greenfield city on which you are building a financial center where there are no regulations. So one side you have to build regulations, other side you have to win the trust of the institutions like present here to come and set up and start operating, which again is very, very challenging because new place with the perception issues behind many of them, whether is it possible, not possible, and if I enter, what could be my challenges, all from the regulation, from tax, and from several other areas. But I think seeing the number, we can say that the Government of India's this initiative and Honorable Prime Minister's the vision of creating its own global financial hub is somewhere started seeing the light of the day in terms of large number of institutions setting up here. We were 129, we reached 810 plus, and I think in no time we will touch 1,000 companies within the IFFC zone, which itself speaks of the volume and number of firms taking their business interest has substantially grown in last 4 to 5 years. And one of the obvious reasons has been that the government initiative of creating a separate unified regulator in the ecosystem. I think we've been working with all the regulators, and it's always challenging. If you have a dual task of domestic regulations and international, you don't know where your time and efforts should be put in. But having this segregation of two zones, once you are in an IFFC into GIFT, you are into a separate unified regulator, you become non-resident. Under foreign exchange law, the domestic foreign exchange law does not apply to you. All this makes life easier for people to come and start operating from. And that's where I think we are seeing large number of growth numbers coming in. We see number of banks, I think, from 14 to 29, and as we speak, I think those banks which have no branches in India are also started to look at GIFT and started applying, which is a positive sign that now you are having, seen more new foreign banks coming in, which are actually not present in the Indian ecosystem also. And the growth of the banks, the numbers that you can see, from mere $14 billion to $81 billion in last 4 to 5 years, has been a remarkable journey for the banking ecosystem in the IFFC zone. Today we were with one of the largest corporate in the morning in our office, and they said that in the recent borrowing with $3 billion that they did, they only allowed the banks in GIFT to participate. They did not allow the banks outside of GIFT to participate. Now, reason of doing that was twofold. Obviously, it's an Indian corporate, and he knows how to save the money. He knows that if you borrow from GIFT, there is no withholding tax. So I think that has been one of the biggest advantages, that utilize GIFT to the fullest. And second, I think if you are getting the same services, you are getting the same, probably better, rates, why not use our own financial center and create business and jobs within the Indian ecosystem rather than creating outside? So from both perspective, I think this is what the Indian corporates are doing now. And then you can see the overall growth. I think recently we have come up with the payment service providers regulation, and there also a lot of interest are coming for both inward and outward payment service providers. And this could become, probably as we move forward, bigger and larger, because the type of the institutions coming in, they are really solving the problems of non-residents. And as the wealth management play increases, in fact, in the afternoon, we met a very smart fintech company, which is going to change the whole onboarding of the NRIs into the system. And that type of companies coming in gives us a lot of excitement that, look, the way the Indian institutions, and they were just like in their early 20s, these 3 co-founders, which have built this from nowhere. And we find that this type of talent and this type of business ideas generating into India, I think the GIFT ecosystem could really find a lot of takers as we move forward. In terms of capital market, in terms of debt listing, my colleague Pradeep is here, who is going to speak after me, so I'm not touching much of the numbers, but you can see there has been a huge change and growth in the way the funds ecosystem has evolved and the way the capital market ecosystem has evolved. Chairman spoke about $84 billion of monthly turnover on the IFFC exchanges and the debt listing which are happening on the IFFC zone. So a lot of Indian corporates are now started using the IFFC for their bond listing. On the fintech side, we have seen some of the fintechs coming in from almost 15, 16 countries outside India. And now we have seen them exiting also into a regulation, into some commercial licenses, which is very encouraging, that you came in sandbox and you are now getting into the regular business from the sandbox. I spoke about the fund industry. I think if you want to invest into India, you want to invest outside, probably GIFT is now emerging as a new platform, and everybody is finding it much more conducive. I think the regulation, tax, and every piece that you really find in an ecosystem, whether a fund administrator, whether a lawyer, consultant, I think everybody is present in the ecosystem. And this is helping grow very rapidly now. Some of the numbers on the on the fund industry, as I mentioned, some of the numbers are very, very encouraging, as you see on the screen. But I also wanted to draw your attention on some of the new activities like aircraft leasing and ship leasing, for example. We have 30 plus firms now in aircraft leasing, and almost 200 assets have been leased into India. And this business was not happening in India before. You can imagine the type of the impact that the IFFC in India can have for the growth of India, and probably then in the South Asian region is remarkable. And we also see some of the ship lessors. In fact, one of the largest ship leasing company today, when they came into GIFT from France, they said, this is a no-brainer for us to open here. And this is not that anybody is doing a hard selling to them. It is they themselves are finding it much more easier to get set up here and get started from the IFFC zone. Now he has a challenge that he wants the first 2 ships to come on 30th April. He has not formed his company also as we speak, but he is very confident that it can all happen before 30th April for him. Now this type of confidence from the institutions, not within India, but from outside India, is really talking of the way I think the new Indian ecosystem for the International Financial Center is growing and expanding. I think I spoke about the service providers. We have almost 86 now, and as we speak, you find a law firm, you find a consultancy firm, they will be probably present here. I only hope that going forward, most of the larger, other smaller consultants or mid-size will also find their way into GIFT, because as we move forward, we want people to use the service providers from the ecosystem. Whether you are using the accountants, you are using the auditors, you are using the consultants, they should be part of the ecosystem. It makes life easier for us as a regulator, because you can always rely on the consultant's license which has been granted by the authority itself. And we are also seeing new wave of entities coming in the treasury center. So if you have an Indian corporate, you want to create a global treasury center for managing your dollars, I think this could be the new wave. And as we speak, I think in the next financial year, probably we expect these numbers to grow very rapidly, the way the Indian firms are structuring their treasury centers in GIFT. And also, if you are a foreign company's Indian subsidiary, you may also consider having a treasury activities within the IFFC ecosystem. We have now foreign universities present in the IFFC, and we are almost 2 Australian universities, 1 UK university we have just licensed, and there are 2 more UK universities which have applied for the license in the IFFC zone. So with this, I thought that this will give you a brief background of what is happening overall within the IFFC. But I think some of the numbers, as I said, Ashish insisted about the banking, and probably, as I said, thanks to our banking team, they provided us some good charts and figures. We are presenting Ashish for the first time in the front of the audience. We are not HSBC or we are not consultants. So if there are anything that you find, up and down in the slide, you can always, give us, being a regulator, we are not expected to make such type of presentations. So this is an attempt to probably help you understand as you understand these numbers better. I think the type of the ecosystem that you can easily see from the liability side, from the asset side emerging from the IFFC zone, and the way the growth has been is probably a testimony to the overall ecosystem really expanding to its fullest in the banking side. And as we keep growing, keep talking to the institutions and investors, we find that whether it is customer deposit, whether it is a multilateral or MTNs, everywhere you see the month-on-month growth and the quarter-on-quarter, the banks are doing extraordinary activities within the IFFC ecosystem. In fact, in our recent authority board meeting, we just observed out of those 29 banks that we have, 25 which are almost operational, the number of employees have also grown very rapidly to 570 now. And this number, which means every bank has on an average now 30 plus employees within the IFFC ecosystem. This used to be 4 or 5 or maximum 8 or 10, which is now grown to 30. And obviously with the retail and the NRI and the wealth business coming in, we are very confident that this number will further grow up in terms of employment within the IFFC zone. I think in terms of asset composition, you can see all sorts of, activities in terms of customer credit or investment in securities, interbank borrowing and interbranch placements. That all has been, rapidly taking shape in the IFFC. We've also seen some of the, probably this is where what we have done is every quarter we come up with the IFFC bulletin now. And if you really see that bulletin, this is actually a slide from the bulletin. So it's not that any confidential data, it's already a public, information available in the bulletin. I'm just putting it here, that you should probably look at the quarterly bulletin, because that now provides a lot of insights into each of the businesses, including the sectors and the areas in which the trade finance or the ECB or other businesses are doing in terms of banks here. And when you see in terms of the number of non-resident deposits, I think this is something which is very close to us, that we want to develop this as a retail hub for the NRIs. Also, residents have started holding their accounts here in the LRS. So even the LRS accounts have started coming into GIFT for investing outside. And we have also seen the non-resident accounts also coming into the GIFT for deposits and for several other business purposes or for investment purposes in the IFFC. I don't want to, but ODI, you name a sector, my only reason of putting this slide was all industries in India have been now participating in GIFT. So we were earlier of the view that only few select institutions are utilizing GIFT, but now if you see the data and numbers, probably all sectors, this is from the manufacturing side, almost type of an manufacturing activity or industry they all are utilizing in some form or the other form the IFFC, trade finance, ECB, and the banking ecosystem. Even the services side, the service industries are also using the IFFC for their banking requirements. And as we see, we do believe that probably, why not 100%? Today we may be almost 50-60%. If you ask in a room, out of 10 corporates, at least 6 to 7 will say, I'm using GIFT for my ECB or trade finance. But from a year or maybe 2 years from now, we will not be surprised if 100% of the Indian corporate says that I am using GIFT for my banking needs. Because it provides you that platform, that extra advantage of using this platform much more efficiently. And even the infrastructure, even some of the other industries are also utilizing the IFFC ecosystem. And at last, I think as we said, the IFFC has to first add value to India. And you can see almost 74-75% of the Indian institutions have been using the GIFT in the total numbers. And then there are countries across globe which are also using the IFFC ecosystem for their financing and other ecosystem requirements. But as I said, I think the success of the IFFC would only come when we see large number of NRI and person of Indian origin and probably the foreign individuals start using this as a wealth management center and use the Indian bank or a foreign bank or a public sector bank present within the IFFC ecosystem and use that for their investments into India or even use that for investing outside of GIFT. With this, probably the ecosystem would see a major change and probably we will then find the fruits of the IFFC to its fullest. As I said, I congratulate HSBC for such a fancy setup with a fancy room. And, as a regulator, we also feel excited to come in this type of room and present because this is something which is really looking in terms of the right institutions, right individuals participating and probably you understanding how the GIFT can be an advantage to them. We are fortunate that some of the large institutions in GIFT have become grown just in matter of few years. Like this came in GIFT and in no time their balance sheet crossed $1 billion. That really makes us feel that this is just a starting point. If you really see the advantage of GIFT, it is going to occur over the next 5 to 10 years and you will see the force of the IFFC business spreading across India and globally. Thank you very much for inviting me and we're really excited to come in this place and deliver. Thank you.
Thank you, Dr. Dipesh. I'll humbly request you to stay on stage, sir. And now I'll request Mr. Sandip Batra to come up the stage to felicitate Dr. Dipesh. Thank you so much, sir. All right, so now, ladies and gentlemen, I would like to request Shri Pradeep Ramakrishnan, who is the Executive Director at IFSCA, Department of Capital Markets. He has worked for more than 2 decades with SEBI and retired as General Manager. He has joined as ED IFSCA from February 2024 and playing an instrumental role in development of capital markets, metals and commodities. Ladies and gentlemen, please join me in welcoming Shri Pradeep Ramakrishnan. Come on, everybody.
If you tell me what you're feeling, I'll say our lives should have no ceiling.
Good afternoon, everyone. It's quite difficult to speak in the afternoon. I think they always say the only person who can sustain the audience interest in the afternoon is a stand-up comedian. So I certainly am not one, though my son is trying to be one, but I am not one. So, but let me try to, at least tell you what has happened in the capital markets and probably where we can go. I'm sure, I think with Dipesh ji's presentation, you know what has happened so far, right? So I think everyone knows that we are quite good as far as the bond ecosystem is, is concerned. We have got almost, almost 200 issues with almost 100 plus issuers taking advantage of this. So much so that this has become the preferred mode for raising, non-India currency finance. So we are quite happy about it. But where we would want a jump would be on the ESG front. While we have had quite a number of ESG issues here, ESG bond issues. In fact, we've even had social bonds out of this place, which a lot of jurisdictions even struggle to sort of get. But what we would want is that yesterday I was at this meeting with Niti Aayog. Now, the government is trying to establish something called the National Green Finance Initiative. Now, through which a lot of capital and funds would be sort of channeled towards achieving our net zero goals. And as per Niti Aayog's estimate, 85% of this money has to come from the international, players. So which means that it makes the IFSCA a lot more significant, and probably this could be one important funnel through which this money could be channelized, because there is no dearth of structures which could be experimented here, as opposed to maybe the domestic jurisdiction, because of the fact that the domestic jurisdiction comes with its own frills, right? So we have worked in the domestic jurisdiction as a regulator, and I can tell you that we could perhaps not experiment with so much products as in the domestic jurisdiction because of the presence of a large retail domestic market. And so we have to sort of contour things differently. This canvas allows us to do that experiment, make this experiment, and probably that could be what the doctor ordered for India's needs. What I was trying to think before coming here was, should I talk about what we have achieved or probably what we should achieve? I think what we have achieved is all over the papers, and Dipesh ji also thankfully made a very lively presentation on what we have achieved. But I think what is important to note is where we have to go. And because as a regulator, very interestingly, we recently amended the fund management regulations. The fund management ecosystem is possibly the most vibrant of the verticals in the IFSC, particularly because of the India story. We have got almost 90+ percentage of the money going into India. only around 8 to 10% goes outside. So which means that again it's the India story that sells. But very interestingly, after a lot of review, for a period of almost 6 months, after the teams making the backs and coming out with the regulation, the first 3 people whom I met after the fund management regulation amendments were funds, asking for a different type of ask it was. But then it actually came to me as to how vibrant and how it could be sort of changed. A lot of new things could be experimented, right? And I think as a regulator, we have to be sort of open to the idea. We can't keep our eyes closed. We cannot adopt what is there in the domestic jurisdiction, which we are trying our best to do. Now, particularly when it comes to the fund regulations, because it's a wealth summit, so I thought probably 2 or 3 things which could come out of my head. One, of course, I told you about the capital market. So in that, while I did gloat about a bond listing, I am a little, the equity listing is a little tepid, rather it has not started. The path to equity listing has been tepid. So as you know, you need not be physically present in the IFSC to raise money out of this, because this is something, a question which has been asked repeatedly. We need to establish here, as much as a bond issuer is not present here to raise bonds, you need not be physically present here to raise equity. And what makes it a lot more attractive is the ecosystem which we have sort of developed is after studying a lot of international practices. And I shouldn't be saying this myself, but if anyone of you has a chance to go through the listing regulations that we have brought, and it talks about both pre and post listing requirements, we have kept it very light touch, very fit for purpose, which would sort of really, it's pretty appetizing. If I were an issuer, I would rather say that. And it's sort of, it's countered to appeal to the startups in India, as well as new age companies in India, and foreign issuers. Now, so far we have got a few interests have been shown by a few foreign issuers, though many of the promoters of these companies are Indian nationals. But of course, they know about the Indian story. But now with 1 in every 6 people in the world being an Indian, the chances of you meeting Indians around the world are, there's no prizes for guessing. So that is something which we have got, and I think hopefully we are able to take it forward. The first 3 or 4 issues will determine the success of this place as an equity jurisdiction. Because over a period of time, I, as a person heading the capital markets vertical, would want the funds and others to invest in the equity here, which would sort of be a barometer for the success of this jurisdiction. So that is something which I want to say. So maybe that is something which we'll take off very shortly. There are a few asks which we have asked from SEBI, particularly on listed companies, raising further capital out of the IFSC. Presently, the rules for those are not yet out. So hopefully that should be done. We are also ironing out a few things with the RBI and the Ministry of Finance, which should also act as a lot more, sort of clear the path, particularly for NRI investments coming through LRS into international investments and other things. Now, when it comes to the fund ecosystem, which has been a good barometer as far as wealth management here is concerned, while we are very happy and we have sort of taken into account a lot of your suggestions going forward and bringing out the new fund management regulations, and which has been also well received, there are a few things which I would want the fund management industry to sort of look at and probably, for the future. One is probably we would need to have ETFs here, and some of the largest ETFs around the world have actually created a lot of wealth. So I would want that to sort of, happen here. So one of the things which I have seen very differently is that in the domestic jurisdiction and also in some few international jurisdictions, while we may have a fund association, we may have, a CII or other equivalent, at some level they do talk to each other. So here what I am seeing is that there is a lot of some sort of a silo-esque approach, whereby a fund talks only to a fund, and an MIA talks only to an MIA. So probably there is a need for a pan-industry discussion, which would sort of throw thoughts here and there. We have tried to make a start by having the Global Securities Markets Conference. It was well attended, and we did get a lot of good thoughts. The other one is that we have recently reduced the PMS limits, and which will make it a lot more appetizing. Now you just need $70,000 to sort of get into a PMS thing here. So, but we would want a lot more PMS people to sort of come in here. So that is something which some funds can actually look at. One piece which has been a lot, a request from a lot of funds is the family investment fund piece, right? While India's family investment funds presently are not allowed, but interestingly, we have got calls from a few international families around the world to sort of invest into India. So these FIFs are something which they have not been tapped. No one has actually sort of thought of going beyond your Luxembourgs and US to probably even, why not look at Vietnam or Sri Lanka, right? These are all places where people have not sort of looked at. And Indonesia or Malaysia, for example. So you've had families, you've had funds, people with money sort of looking at various different places to invest. All it requires is some evangelization of India as a place to invest. And I'm sure that will sort of do it. The other one which I wanted to say is, while I did talk about the ESG piece, unfortunately, there have been only 3 ESG funds, though IFSCA has sort of waived the entire fund fee, which is quite a substantial sum for ESG funds. We have had only 3 funds which have registered so far. So there are still 7 more funds which can avail of the fee waiver. And we would want such funds to sort of come here, probably innovative structures, including blended finance and transition finance, which are going to be the next big things. And this was also talked and dwelt at length yesterday at the Niti Aayog meeting. So blended finance and transition finance is what, and probably funds and companies also will be playing a huge role in bringing that money as far as India is concerned. Because while mitigation finance has actually been received, I mean, though in not large quantities, at least we have been receiving money towards mitigation finance. Towards adaptation finance, we have not been able to sort of receive much money or probably even look at that. So I did talk about the ETF market, but one place which is a very low-lying fruit is something which you can sort of look at is the bullion ETFs, the gold ETFs. So that is something which I'm leaving with you. Probably you can look at starting something on that. I think, as I say, because the FTSE, the MSCI, and the GBS, if you look at it, they have got good indices as far as ETFs are concerned. And we would want our own INX and the NSE IX to have such indices of their own, which will sort of also give a fillip to this place. So the last point which I want to say is, while we are happy that this place is growing, and from, as evident from Dipeshji's presentation, the third column actually showed what has happened the last three months, and there has been activity almost in all the boxes. But what we would also want this place to be, and as CEOs and frontline officers, we would want this also to take home to you when you start entities here, is that we would really want this place to be one of substance. And how will you have substance is when you have real people who are the principal officers, who are the wealth managers taking decisions out of this place. So I understand that initially you may have to work out of places in India, but over a period of time, if this place were to grow as a Dubai or a London, because you remember the thought with which this was established was to be a hub for global capital flows, right? And if we have to onshore the offshore and be a hub for capital flows, a hub of innovation, then it's important that things take place here. So what we are trying to do is that we, with our limited manpower, we are trying to stretch a bit and we have been able to go and advise people, visit people, surprise visits, so that we are able to sort of ensure that that substance stays here. But with this audience, maybe I can leave this request that when entities are started here, maybe I would want you to sort of ensure that substance is also something which is at the the forefront of starting those entities. I wish the conference all the best, and thanks a lot for inviting us. I think this is really well organized. Thank you so much.
Thank you so much, Mr. Pradeep, for sharing your thoughts. And now I would like to take a moment and invite the audience to ask any questions that you have for Mr. Pradeep. Anyone from the audience? Yes. Just a moment, sir. The mic is coming. Sir, आप यहाँ पे आ जाइए, please.
No, I think he would need a mic.
Thank you, Pradeep. That was an excellent presentation. I'm Sridhar, the founder and managing partner of Pegasus India Evolving Opportunities Fund, which is a CAT 2 AIF, but obviously registered with SEBI. But the contemplating and the thoughts on ESG fund. So, would my initiative and passion being climate and ESG going forward, and I think the environment is also pretty ripe. So what would be the advantage of setting up? Because then if I set up an AIF here of CAT, equivalent to a CAT 2 in IFSC, so one is I don't have to go to SEBI for a license, number one. Number two, I also can take money from onshore or inbound and outbound. Only challenge would be that how to take domestic investors also into the same fund.
No,
Because you'll be investing across both India as well as abroad in technology. That's why, so
See-
that issue is still remains, right?
Yeah, see, the thing is, see, we have been set up with a different purpose. And particularly if in this particular case, if you are going to, if India wants to receive funds, then we would want a lot more inbound for the moment. Because the ESG thing which I was talking to you about was more about India as a nation needing more ESG finance. Because we are saying that over a period of probably the next, 3-4 decades, you would need about $14 trillion. And if you're going to look at it, we would need probably 300 or 400, a billion every other, decade. So towards that, then we would need, and from whatever the statistics that have been presented, almost 85 to 90% of this money has to come from, international investors. So I think at this moment, a lot more has to be done as inbound rather than money going out as far as ESG is concerned.
No, I was not talking about outbound. I'm saying that if you set up an AIF here,
Yeah.
you will also get some domestic capital in the fund, like what you do as a CAT 2, domestic investors. Whole objective being is we are facilitating outbound investments coming into India through this AIF because your ESG activity marketplace is India, the largest marketplace, whether it's carbon credits or decarbonization or transition of energy, etc. So from a regulatory perspective, for example, if Indian institutions or Indian family office want to invest, you only have one pot, which is the AIF established in IFSC. It facilitates outbound money to come into the fund, which will invest into Indian enterprise.
Yes, yeah.
And it can also invest into external enterprise.
Yes.
But on exits, it will again come back here and then the tax regulations take place. What about the domestic investors investing in the AIF in India? So that's the challenge, I thought.
I don't know, is there a challenge there, Pawan? I don't know, probably you can help me answer this question. Probably I didn't comprehend it.
Hi, I'm Pawan. I handle funds policy and supervision at IFSCA. So essentially what you are trying to say is, can we pool Indian capital along with global capital at IFSC for investing into
Yeah.
India, right? So the short point is government of India and other regulators would view this to be a
Round
domestic area
Yeah.
business where rupee
Yeah.
capital can also be raised and invested into rupee. As far as IFSC is concerned, essentially 3-4 things which we have enabled, and that's the larger objective. One is, of course, what Sir highlighted, global capital being pooled in IFSC and it being invested into India. That's not a problem. Indian capital being pooled for investing overseas, global and Indian capital being pooled in IFSC again for investing overseas. But one area at this point of time, to be very transparent, which is a no-no for all of us, Indian capital coming into IFSC, going back into India. So at this point of time, to the extent it is
That is
sponsors.
why there is people who set up a Indian CAT. So then you have to have a CAT 2 AIF set up with as per SEBI and then also have a feeder fund and gift only for the overseas investment.
Correct. If you
It
want
is
to,
not equal to what a CAT 2 AIF is offered by SEBI. It can invest in India,
Correct.
Indian rupee, and it also allows foreign money to come into the AIF through
Absolutely.
regulation. It also allows you to invest in foreign companies and because taxation is
and we know all the limitations about that regime
correct,
as
because
well,
that is
right?
the limit SEBI has. But that's a problem, that bucket they'll keep increasing.
Correct.
But I'm
But-
saying it's a huge opportunity given that there is a focus of ESG and especially for people like us who want to invest into climate action, climate tech, deep tech, because we see a huge potential in the next 10 years. And as Pradeep exactly mentioned, there is a huge potential of us also drawing foreign money into it. Let us say 60% comes out of abroad, and 40% of we are able to, give inspiration to Indian family offices and Indian institutions to put money.
No, that's a
Like my
fair point
previous
as
fund,
in
I
from
got
your
SIDBI.
side.
Yeah, so,
So
so,
SIDBI
so
also
let me
wants to
just
come
try
in.
to give a small perspective. I think that's a fair point, I think, like you said. But the issue here is actually presently whatever money comes here and goes back into India is considered as round tripping by the domestic regulator. But like I was discussing yesterday, now the government wants to be, it wants to go full hog as far as ESG funding is concerned. So there could very much be a possibility that certain SOPs are sort of doled out for ESG. A couple of people were even talking about sort of giving an additional withholding tax break for ESG funds, for example, for ESG bonds, for example. So similarly, there could be a possibility. I mean, if it comes, the push comes to show that probably the thing which is prevented, which is sort of prohibited for other funds, could perhaps be sort of okayed for ESG funds. Like Indian money could sort of also be pooled in, and then it can be taken back. But this is something which the NGFI, which as thought fit, could perhaps help out.
No, biggest talking point for you when you talk about this with the NGIF and regulators for getting a favorable for IFSC is that India, a lot of tech guys, India develops tech, implements in India as a market, great, because you have to get to net zero, net carbon credit. But what we are positioning is that you develop tech, and if you want to try your product beyond POC, India is a great marketplace, right? So that's an outcome-based event. So a lot of foreign investors would want to invest in such a fund. Now, Indian family offices, Indian institutions like even NIF or SIDBI, which is again run by Government of India, they're invested in my funds. They'll probably invest. But with this rule, it is inbound rupee money.
That is true. But as I said, probably if the...
But Indian technology, once proved, can also be taken outside and taken to scale, So that's the advantage, especially in climate tech. And that, if they can allow, then the fund manager doesn't have to create two entities, for Indian rupee. Tax regulations can be what they are for Indian rupee.
Because presently, if you're going to ask if an Indian wants to invest, why can't they invest on AIF domestically? So that would be the, the argument which would be given by the, by the regulator. Yeah. But we, you have a fair point, but like as I said, because the government wants to do certain things by 2030, and then which will sort of act as a fillip towards our net zero ambitions by 2070, there is a possibility that these things they may be looked at being exempt or probably partially looked at as being sort of whittled down a little bit as compared to the present requirements.
So my question would be then to Pawan, as to in the current state, how would you then structure a fund that needs to be launched in ESG? Whether we then separately take two funds?
Yeah. Yes.
Separate AIF and then you do a foreign investment. Right?
All right, thank you so much. Actually, we have a panel discussion, but definitely everybody will get an opportunity to meet each other and, discuss further on this topic. Thank you so much, Mr. Pradeep, and I will now request Mr. Sandip Batra to come up stage to felicitate Mr. Pradeep. Come on, everybody, please join your hands.
A digital symphony that will blow your mind.
Thank you so much, sir. Thank you. All right, ladies and gentlemen, we now move on to our first panel discussion of this afternoon, Gift City, India's Global Wealth Hub. As we stand here in Gift City, it is impossible to ignore the significance of this moment. What was once an ambitious vision is now a thriving global financial hub, redefining how India engages with international markets. Gift City is opening new doors for global investments, cross-border transactions, and wealth management. But beyond the numbers and policies lies a larger narrative, one where India positions itself as a powerhouse in the global financial ecosystem, and today for investors, financial institutions, and the future of global wealth management. I would like to invite Mr. Shoibal Ghosh, Head of Investment and Wealth Solutions, HSBC India, to moderate an invigoration session on how GIFT is transforming the world of wealth management in India. Ladies and gentlemen, please give it up for Mr. Shoibal Ghosh.
Hello. Good afternoon, and thank you for being a great audience, asking questions to the earlier speakers. This panel discussion, of course, is very special because as a bank, we are really one of the world's foremost wealth managers, and in India, we reposition ourselves as wealth managers for our affluent and HNI clients. And while I call in a very, very eclectic panel for this conversation, I would also take this opportunity to thank some of our partners who are present this afternoon. Sandip Ghosh, Country Manager, Visa for India and Southeast Asia. Thank you, Sandip, for making it here this afternoon. Our partners, our colleagues from Zolve, Zinc, Belong, and of course, from INX. So all of our partners who are here with us this afternoon, very grateful for your support. Like I said, I think I have a very eclectic panel here this afternoon, and I would want to call upon stage Kalpen Parekh, Managing Director and CEO of DSP Asset Manager. I mean, Kalpen is more known for his social media posts, of course, than asset management, but hi, Kalpen, thank you for making it. Mr. Mahesh Chabra, Fund Manager, State Bank of India, based out of Gift City. Of course, my friend Ashish Somaya, MD and CEO of White Oak Capital. So Ashish is also very social media addict. All right. And then there's someone who's, I think, common amongst all institutions and family offices here, Keyur Shah, tax partner from EY. And finally, somebody from the regulator who's on this panel. And rather than a regulator, we look upon him as an advisor. Half the times he's answering our questions and calls on how to get an approval moving, how to get a product moving. None other than Pawan Shah, General Manager, IFSCA. I have the easiest thing to do this afternoon, given I have to ask the questions and you all have to answer them. Kalpen, since we called you first, we'll start with you. And we've gone back to our clients and we've gone back to our colleagues from around the world to actually pick up some interesting questions, especially about gifts. So Kalpen, the first question comes to you. As someone who's in many ways an international individual, has been traveling and of course knows the international global environment, how do you see GIFT as an opportunity for HNI clients?
So I go back to history. We were the first asset management company 17 years back to launch international funds in India, just around the time when the word BRICS was coined. So when the whole dominance was all money is in India and emerging markets, we launched a global fund. And almost for the next 13 years, we barely got money. And then COVID happened, and suddenly, the whole world realized that the only companies which will make money are the global tech companies, and NASDAQ, flew like a rocket. And from nowhere, international funds in India, from a size of $1 billion, reached all the way to $7-8 billion. That the limits also got filled up. So I think, so that's one point, that global investing suddenly became very, very fashionable post-COVID. But what was the reason for that? Not necessarily the right or the sound reasons that global diversification is very important, but the fact that the last 2-year returns or the last 10-year returns were very superior to Indian markets. So if you take this century, the first decade, 2000 to 2010, belonged to emerging markets, China, India, so on and so forth, and US almost had a lost decade. In the next decade, everything mean reverted. And India returns in dollar terms were much lower than US. So people are chasing returns, and that is one of the reasons why investors suddenly have got excited about global markets. But having said that, in the last few years, and now let's come to the sound principles of investing. The biggest trillion-dollar market cap companies of the world have not come from India. They've come from different parts of the world, and particularly, US or China. So if wealthy investors want to participate in profitable companies also, profitable from a shareholding perspective, there are enough companies outside as well. A lot of these business models are not there in India. But that apart, that's more a sales story. That business model aapko alag-alag milega, and hence you should go. But purely on returns, most of these companies have 20 to 30 to 40% return on capital, 50 to 80% profit margin. So today, if you any one of you open your mobile, there is this feature where you can see where are you spending most of your time on. So it will show you WhatsApp most likely first. In case of Ashish, it will show Twitter, X. Then there will be LinkedIn. Then there will be Netflix or Prime or Amazon. So most of the time the world is spending on these 7-8 platforms, who are the ones who are creating massive profit pools. Almost 40% of world's profit pools went to these guys in the last decade. So by default, where are the profit pools? You need to be there. Of course, right now, a lot of them have become very expensive. They are putting a lot of capex. They are no longer the same free cash flow, only free cash flow generating companies of the last decade, because now they are in this AI race, and who knows who's going to be the winner, and maybe the cycle will turn. But some of the most dominant work is happening outside, and I think Indian investors also need to take advantage of that opportunity. In that context, the platform of GIFT is very apt right now. I think most of these things are falling in place, and markets are also at turning points. Indian markets are expensive, US markets are expensive, but there are some other pockets. Suddenly Europe has woken up from sleep. China has woken up in the last 7-8 months. So there are interesting volatile times everywhere in the world, including India. And if you increase the surface area of the world and not narrow down to just one geography, probably investing can be far more interesting and profitable.
And Kalpen, when you said that post-COVID, this entire area opened up very, very quickly, why would you attribute to COVID? What really happened?
So what I meant is, post-COVID, what happened is traditional businesses obviously had shut down because of lockdowns. Profit pools were getting impacted. And, these global companies, well-networked and running digitally, were continuously, becoming more and more dominant. People were watching more videos on YouTube, so Google had an advantage. We were talking to each other on either Zoom, which zoomed and then crashed again right now, so the wrong example, but whether it is Microsoft Teams, their work was going on. When we were at home, Teams was continuously, helping us do conference calls. We were watching more and more, TV series and movies on Netflix. Stock trading took off everywhere in the world, so interactive brokers and, those type of companies took off. So these digital companies were having a better edge than the companies operating in the physical world. So that was a temporary phase when the world was shut, and they improved their dominance. And we all felt that these lockdowns and all we were not sure whether 1 year from now this will end, or 2 years, but in that 1 year, the NASDAQ itself index delivered 2 to 3 to 4 times more than MSCI World or Indian stock market. So it was also more out of greed. See, ultimately money chases past returns. It may not give you future returns, but most investors, whether they are wealthy or not, we end up chasing past returns, and we think they belong to us. Unfortunately, future returns are very different. But that was a phase of greed which triggered focus on global investing.
Thanks, Kalpen. I'll take that phrase back with me. Money chases past returns. That's an interesting one. We'll use it. Pawan, so we of course talked to you for so many things on the investment side, but and we of course heard Chairman sir and Deepen sir and Pradeep sir talking about what is happening in GIFT. But if we will talk about wealth management and private banking, what would you think is a real vision from GIFT for these two areas specifically?
Sure. Good afternoon to the audience, first of all, and thanks to HSBC for organizing this. Before I answer that and blow our own trumpet probably, let me look at the trends and say what we are witnessing, right? Every year we look at IPL sponsorship and again make out some stories out of it as well. Let me look at the trends in gift. Out of 5 events probably in gift last quarter, 3 events specifically were by the wealth managers. So I'm sure we must be doing something right, which is attracting some of you to travel to gift on a continuous basis. More importantly, on a Friday evening, people from dry state would generally travel to Mumbai. And out of this 3 events, 2 events were on a Friday evening, including one on a Valentine's Day. So this trend in itself, I'm sure, as in would signify something which we are doing right. Answering seriously on the question on wealth management, how we are viewing it and what we are doing about it. So definitely short answer is we would want this area to emerge as the hub for global wealth management activities. And when we say that, what we are looking at it. So we have been very pragmatic about how we can start about it. We did not start with an ambition of going global right on day one. The immediate opportunity which we thought we could capture immediately was pooling of global capital for investments into India, which otherwise would have gone to some other financial centers. So this was the first approach which we did. Indian asset managers who were doing this activity out of other financial centers, we looked at the right regulations, we looked at the taxation structure, what best could be done. We worked with different agencies and cracked this. Because of which we saw quarter on quarter, the investments into India from funds in IFSC increasing at a pace of 30 to 40%. And now we are seeing $7 billion of actual amount being invested into India from IFSC. So that was the starting point. Of course, we would want to support the India growth story. At the same point of time, we also know a lot of Indian HNIs also have aspiration to have global exposure. So this was another area which we started looking at. How can we support the asset managers to pool capital from Indian investors to invest into overseas market? Our colleagues from the mutual fund industry know how big $7 billion cap has been for some of them, and for somebody who has started and seen growth success, and especially post-COVID where there was a lot of interest, they could not take money. So again, a simple LRS structure, a OPI structure which also enables larger families to contribute through a corporate structure has also been enabled only with respect to IFSC. The third piece again, which now we have looked at, and we are pretty happy that a lot of global asset managers are also now setting up their operations out of IFSC for pulling in global capital, not just for investments into India, but investments into global markets as well. In fact, in last 6 months, we have seen now 2 or 3 funds which are purely, there is no Indian leg actually. They are pulling global capital and investing into global opportunities as well. So at least on fund side, all the 3 areas we have seen. Separately, as wealth managers, unlike many other jurisdictions, we see them as an important bridge between product manufacturers and investors. We are one of those jurisdictions. We have recognized them to be an important intermediary. There is a regulation to govern this business in IFSC. People have taken licenses to undertake wealth management out of IFSC, pure play distribution, I would say. And again, a lot of large banks, including foreign banks, have taken this license. And practically what we have enabled is any foreign product or a IFSC product can be distributed to Indians and global markets. Any Indian products through IFSC can also be distributed to the global audience. The only restriction is INR product cannot be distributed to Indian investors from IFSC. That's the only limiting point. And again, the last piece as part of wealth management, the portfolio management services, again, that has been enabled. In a short time period of about a year, we have seen $1.6 billion of assets which are under portfolio management services as well. Probably with time, we'll see more business in each of those areas. Thanks.
And Pawan, as a regulator, you're also looking at what's happening globally in other IFSCs, for example, and are you sort of looking at bringing some of those ideas into the IFSC here?
Absolutely. So when we wear our policy hat, actually, our teams on a continuous basis look at what are the emerging trends, what the world is doing. the entire regulatory structure on family investment funds, right? We saw this kind of structures being prevalent. We saw some of the financial centers attracting ultra HNIs to set up family offices in those jurisdictions. It was with that starting point again, we had enabled such a structure in IFSC. In fact, variable capital company structure, a lot of you have come to us because of the greater legal certainty of a company structure and probably the flexibility of a trust structure, probably a marriage of the structure through a VCC. A lot of ask has been there. So we studied it in greater detail. We looked at various jurisdictions. We set up a couple of committees as well. We made a recommendation to Government of India on it. And then you would have followed, as part of the last budget, the Honorable Finance Minister has also announced the setting up of a VCC structure for funds in IFSC. So this is, again, a global practice that we have seen. We understand why industry is asking for it, and then again trying to work with different authorities and Government of India to help such a structure for GIFT City.
So thanks, Pawan. I think we will, of course, keep coming back to you through this afternoon and later as well. Mahesh, we, of course, are partnering you to help bring to our customers access to one of the world's largest asset managers. As someone who's been in the industry for more than 2 decades and is now seeing this entire shift towards globalization, how do you see GIFT placed to be able to provide you the right platform to be able to bring all that to investors at GIFT?
I think the way IFSCA has been working, right from the time the regulation had come out in 2020 to the updated regulation 2022 and now the recent 25 regulations, they are keeping pace with the international wealth management and financial markets. So where even we have Amundi, who is our JP partner, there also today when we are going to international markets, when we are talking about GIFT, people are recognizing GIFT as a destination. So agreed that Luxembourg, Ireland are also destination, but now even GIFT is being talked about as a destination for investments. If we compare ourselves to, say, Singapore or Dubai-based international financial centers, we are also there. So I would probably say that though they are having a 7-course meal, we are happy with our say a la carte at the moment, but then probably even if you are having a Gujarati thali based out of GIFT, which will have a lot of other, say now, for example, today AIFs have been, are there. So apart from AIFs, if we can look into wealth management, if we can look into private banking, investment banking, at the moment I mean, wearing a fund manager's hat, I would probably like to see a lot of trades happening in GIFT into dollar-denominated currencies, because at the end of the day, that is what we are looking at. So those things will help, say, GIFT to outshine faster pace, and I'm sure IFSC is doing its bit since it's a unified regulator to coordinate with so many regulators and come on its own, differentiate itself from your domestic investors, the domestic continent. That paves a good way for us, for our international investors to look at GIFT as a destination.
So to begin with, while you're saying that we are well placed, and as the pace grows, things will improve and more opportunities will open up as we get the movement and the momentum going through GIFT.
Absolutely.
Sure. So Ashish, we've been talking about opportunities building up in GIFT, and like mentioning that as momentum picks up, there would be opportunity that will keep growing up. My question to you would be that as an asset manager, when you look at GIFT, how do you see, which are the areas which you see gives you the opportunity to actually leverage it best and bring some of your own global capabilities, because of course you have global capabilities to be brought out to GIFT for your investors here?
Yeah, so that behooves me to explain to you what we already do. Obviously we have a entity, in GIFT City. So we do a couple of things right now. One is that we have analysts, or we run some part of our investment advisory. So you know that we have, say, global emerging markets funds. So for global emerging markets funds, some of the advisory is happening out of Gift City. I mean, the fund management license is in Singapore. For example, it's a UCITS fund in Dublin, but the advisory for some sectors happens out of Gift City. Then, of course, we have an inbound fund, which is, as of now, it's a feeder fund which feeds into our multi-cap fund in onshore, but we have a Gift City feeder fund. As a second stage, next we are doing two more things. One is we are creating not just a feeder fund, but a fund actually holding securities directly listed in India. And then the third thing we are doing is we are setting up a fund which will help Indians to invest in emerging markets. So, that will be through the LRS route. Money will be pooled in Gift City and invested into emerging markets. So these are the 3 or 4 things we are doing, and it's in the pipeline, say in the next month or 2 months, right? Now, if you really ask me, I think, there has been a lot of discussion about the growth of GIFT IFSCA. First thing is that we should all be thrilled and excited because, we are probably in the next 20 years, will be one of the largest economies and the largest, we are already one of the largest economies, but also the largest market, right? And probably we are the only large market of size who has attached an IFSCA to our market. See, most of the times when people build offshore centers, it's like, they are searching for something to pump up their economy. So that's where stuff like Luxembourg or Singapore or DIFC comes in. But if you see, India has been a lot more strategic because we know that in the next 15, 20 years, there'll be a lot of capital searching or seeking India. And like he rightly said, why should that then go to Dublin, Luxembourg, DIFC or Singapore or Mauritius? Obviously, it should benefit us. But there are 2, 3 things that we need to look for. See, I'll just quote one statistic. The source is a Jefferies report. Till about a couple of years back, 77% of the money which came into India, it came through some or the other basket, like a global equity fund, a global emerging market fund, a BRICS fund, Asia fund, those kinds of things. Now, if somebody is investing in global emerging markets, then obviously some 15% has to come to India. But it's difficult for them to move lock, stock and barrel, a global equity fund or a global emerging markets fund into Gift City, because then they want to invest in Latin America and Eastern Europe and all over the world. But in the last 2 years, what's the development? Money coming into India, instead of 77% coming from these baskets, it's now down to 65%, which means that money which comes into India as a single country allocation is actually rising. So the probability of more adoption of Gift City is rising because the number of single country India funds is actually rising. If you look at FII flow, in the onshore market, we discuss a lot about FII outflow. In the last 2 to 3 years, there has been FII outflow, but predominantly attributable to global equity funds, global emerging market funds, and those kinds of baskets. But if you look at single country managers like us, the flow is a net positive. So which means that why I think very bullish on Gift City is because apart from everything we are doing to be a global center, one key driver is that India as a single country asset class or India as a single country destination for investment is on the rise. And if you're going to manage a single country India fund, then there is no sense to put it up anywhere other than put it up in India because of all the benefits that they are already providing. So that is something very important to keep in mind. And I think that is actually going to rise in times to come. As far as outbound is concerned, like we are very kicked about outbound. But if you really look at it, for outbound, I think LRS and the TCS is like a huge friction. See, let's understand practically. If I send money today from onshore into Gift City, if I send money today on March 28th, I'll get the TCS back maybe October, November, December sometime. But if I send it in April 2025, that 20% will come back to me somewhere in September 2026, right? So I think there is, we are the only asset manager globally, at least the only one I know of, which for Indian investors, we actually set up emerging markets ex-India because we don't want Indian investors' money to go to an emerging markets fund and again 20% comes back to India. Of course, we don't want that. So we even set up emerging markets ex-India. In Dublin, we have a fund, emerging markets ex-India, and our Gift City fund is going to feed into that emerging markets funds ex-India. But in that whole process, clearly, the TCS on the LRS remittance. So first of all, we have limits. Second of all, we have a TCS on whatever you can send. So I think that becomes a constraint. But like right at the onset, like the chairman said, that at some point in time, we'll have capital account convertibility, and then, it will become really big. So while that is a little far, and, it will take time to remove the friction, but very, very bullish on inbound, because if you're investing in India, there's no reason to go to any other jurisdiction, actually.
Thanks, Ashish. We, of course, are keen on both inbound and outbound, given the large
Yeah, we are working on both. We are offering both. I'm just highlighting the friction because of the TCS and the limits. It's just something to keep in mind.
So, Keyur, like I was mentioning, I think there's hardly anyone in this room who has not once at least given you a call about some tax conversation, especially around GIFT. So my question, of course, is around NRs, and I'll read out verbatim as to what this question says. It says, while we often hear about the competitive tax regime that GIFT City has to offer, can you break this down specifically for NRI clients? Specifically, the specified fund regime for inbound Cat 3 AIFs provides tax efficiencies and significant operational ease for investment through GIFT City. Can you throw some light around this? So NRIs and specifically on some of the elements around GIFT City which enables.
Sure. So couple of points. I think that before we get into the tax part, I think one other very important aspect here was this whole FPI piece for NRIs. If we go back, if you look at the SEBI regulations today, if you are setting up a fund which is going to invest into India and which is going to get a category 1 FPI license, you need to have a diversified fund where not more than 50% are NRI. So in the sense that you can't have more than 50% NRI investment. But if you are a gift fund, you could actually have 100% NRIs in that fund. And I think that was a big, big dispensation which we saw. Obviously, there were conditions around that in the sense that if you wanted that fund where the NRIs are investing, not even the NRIs not to take a PAN number, then you needed to have a single NRI not more than 25% stake in the fund. But otherwise, if you want to set up a pure NRI fund, GIFT is the only place you can set it up. And I think that again should help many of the Indian domestic asset managers to look at this in a very interesting manner. The other thing from a tax perspective, obviously, is that the whole regime is broadly similar to what you could have seen, say, for example, out of a Mauritius or a Singapore. So your long-term capital gains would be, and short-term capital gains arising from cash equities would be taxable at the regular rates. Your income from derivative transactions, if you are investing into a category 3 fund and being a non-resident investor, the derivatives would be exempt from tax, and so would be the debt. Any income arising from debt would be exempt from tax. Interest and dividend, again taxable at 10% as against the domestic rate of 20%. So that is broadly what is there. Also, if you are an investor in a GIFT City fund, including the fact that if you are an NRI investor and you don't have any other income, you don't even need to take a PAN. I think that was again a big dispensation that you don't need a PAN, because everybody was worried that, boss, one more hassle, get a PAN. If I have a PAN, that means that I'll get a notice. Then again, I'll have to disclose a lot of information. So all of that stuff is gone.
So basically, by NR, it's significantly more efficient to be here, and ease of operation is significantly higher than operating out of India.
Yes, and again, there is one very unique structure which we could look at, is that if you are a category 3 fund which is investing entirely its proceeds in a local domestic mutual fund, then if all goes well, you can actually get income completely tax-free. Because any distribution from the gift fund to the NRIs is exempt from tax. Any distribution from the local fund to the gift fund is exempt from tax, and the fund itself is not subject to tax. So that whole chain can actually be fully exempt from tax as long as it does not qualify as a retail fund, because retail fund has its own set of implications, because I think as usual in its exuberance, the tax department has complicated what a retail fund can do and cannot do. But otherwise, I think that you can do a beautiful structure where you can actually get completely tax-free, which can again only happen if you are investing from gift.
Okay, you don't get surprised if suddenly you start getting a lot of calls on your phones about complete tax-free investments. Kalpan, when you were talking about global investments, we spoke about the limit that currently prevails, because of which a lot of asset managers are finding it difficult to invest into global markets. We know for a fact that our customers, at least a majority of them are wanting to invest at least 20% of their portfolios on an ongoing basis to global markets. How do you see GIFT enabling this in the context of global investments?
That's why I said it's very perfectly timed, because actually the... Thanks. I forgot what was the question. Global investors, 20%, yeah. Sorry, some sudden memory loss. Through mutual funds, it's the best way to invest. Today in India, for example, on the onshore market, you can invest in a fund which is investing in Indian stocks, global stocks, combination of all, just one single check. No hassles at all, can be done, but the limits are shut. But ideally, given a choice, I would love to use that route to do my investing. Now that limit is shut for the last 2.5 years, and we don't know when will that open up. And the LRS limit is open, and GIFT City has enabled that. And like last year, I invested for the first time ever through LRS by setting up an account in Interactive Brokers. And I have a friend of mine who is a great stock picker who recommended 7, 8, individual companies, and that investment happened. But why should that investment separately go out of the hands of Indian money managers or the Indian ecosystem? And with this new template on LRS on GIFT City, as we now set up, like we are on the verge of, we are awaiting approval anytime soon to set it up. Incidentally, we are one of the largest funded AMC on GIFT. So in India, our rank is 10. Probably in GIFT, we may be in the top 2 or 3. For a change, somewhere we are in the top 1, 2, or 3. So I think this is a great opportunity. And the need to diversify your portfolios sensibly, prudently, across asset classes and across geographies was important always. Not just today, but always. But now the timing is so good that the opportunity is there and the platform is there. And I think there are a couple of funds already there on GIFT City offering the LRS route. And we are also hopeful. I intend to talk to Pawan after the session on a few things that, in fact, HSBC is also part of that conversation.
Sure. Yeah. We'll look forward to that. Thanks, Kalpan. Mahesh, from your perspective, especially given the current conversation with Amundi, what are the different strategies available at GIFT City? What do you think are really relevant to an investor audience at this point in time?
I think the key strategy is basically to take benefit of the tax regime over here. Though we run a long-short fund, which is a combination of a bottom-up and a top-down approach, wherein we take the top-down call based on what our asset allocation framework says, and then do the stock picking. So as far as equity is concerned, I think long-short strategy is what we are having for inbound kind of investors. Outbound also, we are opening up a global disruptive opportunities, which is actually managed by our Amundi partner. So that will be a feeder fund. Your mutual fund, as Keyur was mentioning, the tax advantages of investing in a fund, and then it comes back as tax-free to the final investor, being a Cat 3 AIF. So that is something on the equity side. Even on the debt portion, the private credit space can be a very good destination for GIFT per se. Here, you have a couple of them. You have, say, certain funds who are all in early stage, late stage, as well as growth stage financing, who are based out of here. In debt, typically you can broadly categorize it into a cash flow kind of a funding and a balance sheet kind of a funding, where in cash flow you look at direct lending as an opportunity. Then you have mezzanine debt. I'm talking about the possibilities. I'm not saying even for these structures, even in Indian markets may not go on, but the possibilities where AIF can come in and actually make a difference. So of course, distressed debt we do have over there. Venture debt is already there. Here. On the balance sheet side, real estate, infrastructure, your farmland financing, if you're going deeper inside, that has got good potential. Even structured finance for that matter, if you are raising a consumer loan or an auto loan, you convert that into a security receipt, make it as a security, it becoming probably get classified as a debt security, and then it will get its tax advantages. Now, there are dearth of investors, rather dearth of issuers on the say zero coupon bond size. Now, assuming an ideal scenario that there are issuers, maybe 5 or 6 issuers, who are raising dollar-denominated debt, but a zero coupon bond. So it's a win-win situation, because here capital gains are free, but if it comes to a coupon, it probably gets taxed. So if it's a zero coupon bond, you will have an opportunity. If it is dollar denominated, again, you're protected from currency side. So, I mean, there are a lot of these structures which can come up. I'm talking about, again, possibility, because we have to get our bread and butter right in terms of, first get your equity, the volumes higher. So today, if, again, wearing a fund manager's hat, if I have to invest, I'm going back to the Indian markets and investing. So maybe if IFSCA or some regulator could make a listing of Indian equities in GIFT, maybe more appealing for them. I believe that capital gain tax also for an entity who is listed in GIFT, that becomes zero as compared to what we are issuing when we are investing over there. So again, a further tax advantage for the investors to look at. So I feel this, I mean, there are a lot of things which we can do. We should take one step at a time, consolidate in one. So today the pain point is, try to get a lot of volumes happening in GIFT itself, and increase the listing criteria in GIFT. I think that will be a good platform for many issuers to come in, and when issuers come in, you will have investors. So I think it is like joining together and working together.
Sure, thanks, Mahesh. Keyur, you spoke about non-resident Indians, but resident Indians, I mean, what does GIFT really provide for resident Indians? We, of course, like I was mentioning earlier, very keen to enable resident Indians to invest globally. What kind of benefits are there for resident Indians when they invest through GIFT?
Very short answer, not many. And that is also being kind. So if you are basically a resident investor putting in money in, say, for example, a category 3 type of a fund, obviously, as was mentioned earlier, you have to first go through the hurdle of the LRS and therefore the TCS if it is more than 7 lakh rupees. So that is the first challenge. The second is that any income which you receive from that fund is then taxable in the hands of the resident as regular income or capital gains, as the case is. There is a little bit of an issue there as well, where if the fund is not properly structured, then the income accruing to the fund, even without distribution, could become taxable in the hands of the individual. And therefore, that is again been an ask of the IFSCA that at least you clarify that as long as the fund has not distributed any income, the resident is not supposed to pay tax, because that is again bringing more parity with Mauritius or a Singapore, where if you invest outbound, then unless you have a distribution event, you don't pay tax. So I think that is a little bit of a challenge. Obviously, as Kalpen mentioned, if you are an investor and a resident investor and you want to invest outside, there is not much choice you have right now, because the 7 billion limit is stuck. I don't think there is any movement on that. So choice nahi hai, you have to do an LRS and use the fund, or use the OPI route if you are an investor who is coming through a family office, where you can invest 50% of your net worth under the overseas portfolio investment scheme. But there again, it cannot be a single family office, it has to be through a portfolio manager.
Interesting. So no choice, hence gift could be a catalyst to at least get the move going.
Yes.
But there's more to be done, more clarity required. and so
Yeah,
forth.
unless SEBI changes that limit, I think no choice right now.
Sure, thanks, Keyur. As usual, always candid. Pawan, we of course have seen the launch of a numerous number of PMS and alternates in the GIFT City. One of the things that we encountered, of course, is retail investors also showing interest in investing in GIFT City. And while we've been talking to a number of asset managers, some of them very keen to use some of the key regulations around retail investing, but the momentum doesn't really appear to have picked up. Some thoughts around what's happening. Are you doing anything more to sort of encourage retail participation?
Sure. So let me, of course, the growth has not been there. Retail schemes, because of various reasons, has not been able to start. Let me share the perspective with which we started, right? We as unified regulator, let's look at some recent history. So when we started in end of 2020, and before we started, SEBI was the regulator in charge for capital markets and IFSC. So there was a regulatory regime for alternative investment funds in IFSC, which was laid out by SEBI when we took over. When we started, there was no regulatory regime itself for a mutual fund sort of structure. Of course, and when this was started with the domestic experience, by and large, the domestic SEBI AIF regulations were replicated for GIFT City. So immediately what we did in the first 18 months was, in that particular regulation related to AIF, we started removing certain clauses which were not very relevant for an international financial center. Again, there was no tax treatment for AIFs as well. So then we had to work with Government of India, Department of Revenue, get a specific tax treatment around alternative investment funds. And again, out of all businesses, as in for banks, it's a simple 10-year holiday for 15 years, but funds is a pretty complicated structure. Listed is different, unlisted is different, debt is different, equity is different, long-term is different, short-term is different. So in fact, even the tax guys are probably fed up of us because every year there is a new ask. Because there are so many different structures which are there. Having said that, so each year we started trying to resolve some or the other areas. And during this process, of course, retail was, as in at that point of time when we started, we wanted to touch upon those areas where we could start immediately. So only in the middle of 2022, we came out with our own set of comprehensive regulations on fund management business, which also inter alia provided for retail schemes in IFSC. So the regulations came as in very recently, number one. Number two, even when the regulations came and people were interested, I remember as in there were a couple of conversations, people wanted to do a mutual fund sort of structure. There were people who wanted to do a ETF as well. Unfortunately, we did not have a tax treatment. And it was not about having a favorable tax treatment. There was no tax treatment itself available to a retail scheme in IFSC. And of course, with that uncertainty, nobody would start up a retail scheme. So only again after the government came in power again in July in the interim budget, they had announced for a tax treatment for retail schemes in IFSC. It was only after that people started looking at tax as in setting up retail schemes in IFSC. In fact, quite a few people were enthused about it. They filed their offer document as well. And as Keyur rightly pointed out, there was a sudden surprise which came out of CBDT. Which again, as in people got approvals to start retail schemes, they were very keen, they had done everything, and again, they could not start because of some tax requirement. So again, we have gone back to Government of India trying to resolve. We are expecting it to be resolved sooner than we expected. So once that is resolved, in fact, we would see a host of retail schemes being set up in IFSC. As we speak, a year end, we review our quarterly filings. This is the year when we are including detailed portfolio disclosure requirements and all of it for retail schemes, because as a regulator, we are optimistic in the next financial year, we will see retail schemes and ETF being set up in IFSC. Let me, before I end on this area, also touch upon one point which Mr. Keyur previously mentioned about the tax treatment for AIF Cat 3. While there is complete parity on most of the aspects when we look at the specified fund regime for AIF Cat 3, and as in he's an expert on tax area, and as regulators we have limited understanding. Still, the most important thing which we look at in terms of tax is the certainty which IFSC provides. The entire tax treatment is hard-coded under the Income Tax Act. And unlike when the fund managers rely on DTA arrangements which are always questionable at some point in time in future, the tax treatment which is available is hard-coded. Again, the substance requirements which is expected, we as regulators have clearly laid out in our regulations. So that way for asset managers, and at least in my interaction with asset managers, including of very large global asset managers, they are saying we will pay even 100 bips more, 200 bips more if we have to come to GIFT City. But if we get a greater tax certainty, that is something which we would always look at. So that's another area I thought at least I'll mention.
No, I completely agree. I think that if you look at most of the tax treaties which are there, you obviously need to qualify and spend a lot of time in deciding whether you will get the right level of tax certainty. But when you come through GIFT, at least your the aspects around what is exempt is very clear and hard-coded, and therefore to that extent all the issues around the general anti-avoidance regulations or anything under what we call as the principal purpose test don't need to be satisfied, and it gives you far more certainty. And I think that is the one piece which causes a lot of excitement as well.
Keyur, we offer a number of inbound investment opportunity at GIFT City, and some of the strategies that we play out are on the long-short strategy that comes our way. We understand that there are some nuances to taxation to such strategy. Would you want to share some of that with us, please?
Sure. So one point, obviously, as Pawan sir covered, I think the whole tax certainty aspect, if you are inbound, is very important, and that is what gets covered here. As I said, that if you earn any capital gains on inbound investment through the FPI route in Indian securities, if it is through cash equities, your income is exempt from tax. If it is any other instrument, including investments in units and or debt funds or debt, it is exempt from tax. Cash equities, is taxable at the regular rates, so 15%, 12.5% and 20%. The other thing which is there, which is also very interesting, is that if you are trading on GIFT listed stocks, then your entire income is exempt from tax. So anything which you trade on GIFT securities, that is something which is exempt from tax. The only other nuance which is there is that if you were investing from a Singapore or Mauritius or Netherlands or Ireland, you had the ability to set off one gain against the other. So say for example, you had made gains on your futures and options and losses on cash equities. You could choose not to follow the treaty and pay tax under the Income Tax Act on a net basis. However, because under the domestic law, futures and option income is completely exempt, you can't set off losses against gains from futures and options and cash equities. It's a small nuance, but it may become a little important when you look at investments through GIFT City. So while it provides you absolute certainty, it is a structure which is far more cheaper compared to any Singapore or a Mauritius structure. Substance requirements are very clearly mentioned under the regulations and therefore should not get questioned. I think this netting off aspect is something which could be a little tricky when you look at investing into India.
So there is an opportunity available in the derivative space, and obviously you
no, absolutely. Absolutely fully exempt. So if you are a fund which is going to be high frequency trading and or someone who essentially invests in futures and options and want tax certainty, then GIFT provides you the best alternative.
Super, Keyur. Thanks. Ashish, we're speaking about this before I request you to come on stage, private markets for us, of course, has been a strategy that we believe is really playing out for us in India, and especially with GIFT, what happens is it gives us access to private markets globally. We, of course, fundamentally believe that private markets in many ways hedge the risk, the public market exposure, and obviously in a market like India where there's so much of startup action happening, private market is a great opportunity. What are your views around this? And when you as an asset manager look at opportunities in private market, what are the 2 or 3 things that you possibly look at exploring?
Yeah, so I told you what we're doing till now is all public markets, but as a next step, say for example in India, on the onshore market, we are just about to launch a Cat 2, which will be a combination of listed, unlisted, pre-IPO, late stage. So obviously we are creating now, this time not a feeder, somewhere in the, say, fag end of 2025 or maybe third quarter of calendar 2025, we'll be obviously approaching the regulator to create a inbound, equivalent of a Cat 2 inbound fund for global investors to invest in India in a combination of pre-IPO as well as listed. So we are slowly and steadily, building the whole suite. Of course, we are not into early stage or VC, but definitely a combination of pre-IPO, late stage, that is something that we are looking to create out here.
So like any other investment, important to diversify across different stages when you're looking at private markets. A stage may not be the only strategy to play out, I'll guess.
Absolutely.
Super. Thanks, Ashish. Kalpen, we are talking about products now, and of course, we have a range of products available in GIFT, starting from simple products like UCITS to many more complex products coming our way. But as an investor or as an advisor talking to an investor, what do you think are the sort of products that an investor should start off investing, especially in the global markets?
I will actually, sorry for that. Most investing is done through the lens of the name of the product or the classification of the product. And I think that is where many mistakes and errors are made. Personally, my approach here, and I'm not just wearing the DSP hat, but even the DSP family has this approach that when you're investing, whether in India or outside, ultimately you're buying cash flows over a long period of time and at a price. Everything else is nothing but a wrapper in between. And it may be called an AIF, it may be called a PMS, it may be called an IFSC, LRS product, it may be called a usage product. Ultimately, you're buying cash flows. So the labels will keep changing depending on nuances and jurisdictions and fee structures and what is more appealing. There are so many clients to whom, we say that, and we have this experience in our own investments, that if you club all private products, all AIF products together and check the returns versus simple Nifty, most likely Nifty will show superior outcomes, post-tax, with liquidity and all of it put together. But it's not exciting to talk and say that, I'd invested in Nifty. That's the final truth, that if you want your wealth to compound in the simplest form, basic products make the most sense. Now, there can be nuances where you may not have access to a basic product because of regulatory reasons, but I would always say that start with the basic range first. In India, you are perhaps the first wealth management company a few years back who adopted this principle of simplicity, who said we will not do new funds, we will not do complex stuff, you move to a full trail model, so on and so forth, which is aligned to investors' interest. So I would say that start with asking a more fundamental question. When wealth investors are saying, where should I invest? Instead of saying, which AIF should I invest in, or which mutual fund scheme should I invest in, which large cap fund should I invest in, start by asking that, what is the underlying? And is the underlying suitable for you or not? And is the underlying at this point in time attractive or not? Is it more risky or safer? Most often, the four most dangerous words in investing are others are doing it. So there's always a wave for an asset class or for a vehicle. So I personally feel that, and which is why, even when we have started our entire GIFT journey, so while we have some global investors who are invested in our strategies through GIFT, which is mostly in the long short fund, because they always felt that Indian markets are attractive but also expensive. And that is where our long short fund became a very relevant product. But when we look at our high net worth individuals in partnership with you or direct family offices, our first product for them would be a simple equity fund diversified around the world, only on principles of 4 words: buy, cash flows, cheap. That is a simple one-line ideology around which we normally encourage investors to think about investing.
So basically, Kalpit, start with the simplest of product.
Absolutely.
And then as you mature as an investor, look at more interesting ways of investing. Great. Pawan, this is the last question on this panel, but of course we'll keep asking more questions as we step away from here. You spoke about VCCs, I think the conversation around what VCCs. Tell us a bit about what VCCs are and what is GIFT really doing to make VCC a credible opportunity inside GIFT.
Sure. So variable capital company structure has been there in existence in some jurisdictions. It is known by different names in different jurisdictions. Some call it protected cell company. There have been different names. Essentially what it does is it gives a corporate structure to a fund, and then when somebody is doing multiple strategies through multiple schemes, how do you ensure that the investors in one scheme are ring-fenced from the investors in other schemes? In a trust structure, while it has never been challenged in court of law, it can always be questioned. But it's only a simple trust structure where multiple schemes are being floated. And essentially, the regulator says that each scheme has to be ring-fenced from the others. There is no legal sanctity which is given to this sort of structure, which is the attempt by some of the regulators globally to give more legal sanctity to a fund structure by giving them a corporate entity sort of structure. And let's say if somebody has to do immediately a company sort of structure otherwise for a fund, then the requirements of the Companies Act in any jurisdiction which otherwise would flow in, it would become unviable for anybody to comply with disclosures of shareholders, going for voting at each point of time, disclosure of members and all of it. So essentially, a company structure with a lot of flexibilities which are otherwise available under a trust structure are married into a one structure and then rolled out for the fund industry. That is essentially VCC is all about. And that's what our aim as well is, to give a lot of flexibilities today as we speak. And Mr. Keur would again endorse that it is not of a problem of the regulation where fund managers are not able to do multiple schemes in the same trust. It flows because of some GST and SEZ requirements. So if we have to enable a structure which will allow fund managers to seamlessly start immediately, that has been our effort, as in at least in terms of what all we can do in terms of ease of doing business for the asset managers. If they have an idea, if there are investors ready, if they want to start immediately, what all we can do for them to start as soon as possible with a legal structure which is more acceptable to investors across the globe. And it is with this idea we have been working with Government of India. In fact, a draft law jointly has also been readied. It needs to be placed before the Parliament and all of it, but we are working very closely. In fact, we have had a couple of industry interactions. We facilitated that with the Government of India. So hopefully we will see the light of the day soon.
Super, thanks, Pawan. We look forward to that. Mahesh, this of course, the second last question of the panel. So, given your rich experience in asset management and listening to what the regulators are saying at this point in time, what would be your area of focus in GIFT from here on?
So, in GIFT, primarily, I mean, as a fund manager, my immediate ask, as far as the regulator is concerned, is to enable the listing of entities so that, you know, the tax element, what we are talking about, that get enhanced to the extent of the capital gain tax that gets taxed to the investor. The other aspects that, from an asset manager point of view, I think would be onboarding of investors through a digital platform, wherein today, when you're going globally, you have to actually physically hand over the document they fill in because those are regulated, but then come out, maybe the regulator can come out with some aspect, even the digital aspect is regulated, but then it becomes easier for the investors globally to enter into that. I think one more thing where we could also look at is an omnibus structure, where it is an internationally accepted, say, practice. Though it is a structure which is not not so much, it's not allowed in domestic India, but that is the reason why gift is. So gift is separate from domestic India. So we could also look at some of the international best practices followed, and we can adopt that to the extent of being more conservative than what others, at least put in a place wherein we can. So at the end of the day, there are dearth of ideas over here. All we need are assets and investors. So once those come in, I think everything else will follow.
Super. Thanks. I'm sure Pawan is taking notes. and I'm sure you're going to have more conversations with him. Ashish, I don't know how, but the last question is like, you have the last word on this panel. So this is not my doing. I don't know how it's happening like this. But let me ask this question. It says, given your experience with leading wealth and private banking counterparties globally, are there any key trends which are relevant for India, more specifically?
So are they?
Given your experience with leading wealth and private banking counterparties globally, are there any key trends which are relevant for India, and more specifically for GIFT, which you would want to share with us? Anything that you see GIFT City counterparties are doing much better than what's happening globally? Your experience on this?
See, I think, obviously like I mentioned, that as India becomes more of a single country asset class, there'll be more. See, let's look at it practically. I think this is somewhere we need realistic expectations across. So let's look at it practically. If you were to land up with a private banker or a wealth manager or a family office in Geneva or Zurich, or even in, say, Qatar or anywhere. So as an Indian manager, my first task will be to promote India and encourage them to make an India allocation. When it comes to encouraging India allocation, the second step will be White Oak Capital. And then when everything is done and dusted, you say, okay, let's sign up. And when it comes to signing up, they are used to Luxembourg or Dublin. So then you will say, why Gift City? Taxation, India's, offshore center, all the benefits, etc. Correct? So there are certain hurdles that need to be crossed. So what will happen is that, like I said, as India becomes a single country exposure, more and more people will get appreciation or get understanding of why they should go for a Gift City fund. But as we speak right now, people are very used to Luxembourg, Dublin, Singapore, Mauritius, what have you, correct? So I think we all need to promote, when India becomes a bigger investment, automatically India's vehicle becomes a bigger investment. That's one. Second thing is that, I would appreciate, I agree with what Mahesh just mentioned, because even when we were talking, I may be wrong, pardon me for that, but even when we were talking, for example, why does a discussion on offshore center need to even think what is NRI? NRI is a foreigner. How does it matter? See, because I think what I find is that as long as you do not declutter everybody's mind that onshore is onshore, Gift City has nothing to do with onshore. It's just that there are multiple people all over the place who are consistently double hatting. And then they are, like, what you mentioned was very insightful, that you received regulations which were actually crafted for the onshore market, and then you had to say, okay, this is not relevant, this is not relevant. So instead of making it relative, you need to start ground up absolute, that how is an offshore center. Right now, if you, at least from what I understand, is that if you are a ground up absolute basis offshore center, then how does it matter whether it's a foreigner or an NRI? It's basically somebody who's a global investor looking to invest in India, correct? And it's not like there is any special benefit. Whatever is there for offshore center for any global citizen is there for everybody. So I think what is happening is that a lot of stuff is being done relative to onshore. And I think in a global offshore center discussion, onshore should not even come up. As long as you have ensured that Indian investors cannot round trip, as long as you have ensured that India's, demonetization, GST, RERA, tax compliance, widening the tax net. You do all of that onshore and you make a thorough job of that. But once you're doing that, then in an offshore discussion, onshore just shouldn't land up, right? It needs to be made bottom-up, absolute basis. I think that is something which is crucial. And then the best practices will automatically come up because like Mahesh said, internationally, an asset manager doesn't KYC every investor. We receive money from HSBC, right? HSBC knows all its customers. So for my fund in Dublin, HSBC gives me one check or payment. I don't go around asking you who this is, right? So that is the global practice, that the bank does the KYC, the asset manager just manages the money. Now that's he's right, that's a best practice. But for that best practice to be adapted, you need to think onshore and offshore very, very differently. In an offshore discussion, onshore shouldn't come. There should be nothing like NRI for an offshore discussion.
Interesting, Ashish. Kalpan, you were trying to say something.
It's just like class participation. So, in a way, what I think Ashish is saying is that it is money coming in rupees versus money coming in dollars. Anything in dollars becomes a separate framework in itself, and de-anchoring it from the rupee market, which all of us are used to with our own regulation. And the biggest opportunity, and thankfully, I've interacted with the GIFT team, with Pawan and all of them. Their mindset is that let's benchmark to the global practices and not the domestic practices necessarily. So that is a great starting point. And also what Ashish mentioned is that we have to also think from the lens of the customer to a certain extent. Typically what happens is we always think about us. DSP will think about DSP. Maybe IFSC will think about IFSC and India, and nothing wrong. But ultimately, how does it matter to the customer outside who is used to 100 years of investing through their own practices and compliances? So how can we, while safeguarding our interest, be globally competitive and give them simplicity of access becomes a very large opportunity to capture. And I think those trends are clear. A few days back, I have a sister living in Hong Kong and I go there twice a year. Over the last 5 years, in the first 4 years, there were no meetings I used to get from local investors. In recent trips, in a week there are 20-25 meetings. So investors from Asia and Chinese capital, which is also looking for investing abroad, wants to evaluate investing in India. So I think the timing is great for us. The world wants to think of India over time as a meaningful asset class. We have only 2 or 3% in the larger pool of global capital. Through GIFT, I think the runway is great, and the regulators here are thinking really contemporary, thinking world class, and I'm very hopeful that. So I've been distracted because I have a group of GIFT City discussions in my company, and there are a few discussions already going on right now. So that's the type of excitement we have for scaling this up.
Super, thanks Kalpan, thanks gentlemen. And it's been an absolutely outstanding conversation, very, very insightful, and like Kalpan, who's taken very copious notes, I think 2 pages of them. Pawan and Keyur, I'm sure you'll get to hear from Kalpan very, very soon. But thanks a lot for your time. We obviously are very, very hopeful about what GIFT has to offer. HSBC's wealth management business, private banking business, fundamentally believes GIFT is a great, great corridor for us to reach out and enable our customers to invest globally and vice versa. So we will, of course, look forward to more interesting conversation, and hopefully Keyur will keep guiding us on more interesting tax opportunities. Thank you, gentlemen, for your time. Really appreciate. Thank you for listening to us.
Thank you so much, Mr. Shoaibul Ghosh, for moderating this session so well, and thanks to all the panelists for such an informative session. So now I'll request Mr. Shoaibul to present the memento to each panelist. Thank you so much, everybody. Thank you so much. So now, ladies and gentlemen, it's time for a short tea break. Relax, get yourself energized, and please come back in half an hour because there is another insightful panel discussion after this. Thank you so much, everybody.
Ambition is too precious to be bottled up, too powerful to be kept on the bench. It's the magic potion, your secret weapon. It wakes you up in the morning and keeps you awake at night. So why hold back? Unshackle it. Let it fly. Let it dance. Let it bring the rain. Let ambition fuel your next chapter. And let HSBC be your partner in this journey. With our knowledge, our network, our experience, we've seen ambition bear fruit again and again across the world. Connect with us. Ambition is too precious to be bottled up, too powerful to be kept on the bench. It's the magic potion, your secret weapon. It wakes you up in the morning and keeps you awake at night. So why hold back? Unshackle it. Let it fly. Let it dance. Let it bring the rain. Let ambition fuel your next chapter. And let HSBC be your partner in this journey. With our knowledge, our network, our experience, we've seen ambition bear fruit again and again across the world. Connect with us. Ambition. It's too precious to be bottled up, too powerful to be kept on the bench. It's the magic potion, your secret weapon. It wakes you up in the morning and keeps you awake at night. So why hold back? Unshackle it. Let it fly. Let it dance. Let it bring the rain. Let ambition fuel your next chapter. And let HSBC be your partner in this journey. With our knowledge, our network, our experience, we've seen ambition bear fruit again and again across the world. Connect with us. Ambition. It's too precious to be bottled up, too powerful to be kept on the bench. It's the magic potion, your secret weapon. It wakes you up in the morning and keeps you awake at night. So why hold back? Unshackle it. Let it fly. Let it dance. Let it bring the rain. Let ambition fuel your next chapter. And let HSBC be your partner in this journey. With our knowledge, our network, our experience, we've seen ambition bear fruit again and again across the world. Connect with us. Ambition. It's too precious to be bottled up, too powerful to be kept on the bench. It's the magic potion, your secret weapon. It wakes you up in the morning and keeps you awake at night. So why hold back? Unshackle it. Let it fly. Let it dance. Let it bring the rain. Let ambition fuel your next chapter. And let HSBC be your partner in this journey. With our knowledge, our network, our experience, we've seen ambition bear fruit again and again across the world. Connect with us.
Check, 2, 2. two, two.
Ambition is too precious to be bottled up, too powerful to be kept on the bench. It's the magic potion, your secret weapon. It wakes you up in the morning and keeps you awake at night. So why hold back? Unshackle it. Let it fly. Let it dance. Let it bring the rain. Let ambition fuel your next chapter. And let HSBC be your partner in this journey. With our knowledge, our network, our experience, we've seen ambition bear fruit again and again across the world. Connect with us.
Check, check, check. Check, check.
Ambition is too precious to be bottled up, too powerful to be kept on the bench. It's the magic potion, your secret weapon. It wakes you up in the morning and keeps you awake at night. So why hold back? Unshackle it. Let it fly. Let it dance. Let it bring the rain. Let ambition fuel your next chapter. And let HSBC be your partner in this journey. With our knowledge, our network, our experience, we've seen ambition bear fruit again and again across the world. Connect with us. Ambition. It's too precious to be bottled up. Too powerful to be kept on the bench. It's the magic potion. Your secret weapon. It wakes you up in the morning and keeps you awake at night. So why hold back? Unshackle it. Let it fly. Let it dance. Let it bring the rain. Let ambition fuel your next chapter. And let HSBC be your partner in this journey. With our knowledge, our network, our experience, we've seen ambition bear fruit again and again across the world. Connect with us. Ambition. It's too precious to be bottled up. Too powerful to be kept on the bench. It's the magic potion. Your secret weapon. It wakes you up in the morning and keeps you awake at night. So why hold back? Unshackle it. Let it fly. Let it dance. Let it bring the rain. Let ambition fuel your next chapter. And let HSBC be your partner in this journey. With our knowledge, our network, our experience, we've seen ambition bear fruit again and again across the world. Connect with us. Ambition. It's too precious to be bottled up. Too powerful to be kept on the bench. It's the magic potion, your secret weapon. It wakes you up in the morning and keeps you awake at night. So why hold back? Unshackle it. Let it fly. Let it dance. Let it bring the rain. Let ambition fuel your next chapter. And let HSBC be your partner in this journey. With our knowledge, our network, our experience, we've seen ambition bear fruit again and again across the world. Connect with us.
Check.
Ambition is too precious to be bottled up, too powerful to be kept on the bench. It's the magic potion, your secret weapon. It wakes you up in the morning and keeps you awake at night. So why hold back? Unshackle it. Let it fly. Let it dance. Let it bring the rain. Let ambition fuel your next chapter. And let HSBC be your partner in this journey. With our knowledge, our network, our experience, we've seen ambition bear fruit again and again across the world. Connect with us. Ambition is too precious to be bottled up, too powerful to be kept on the bench. It's the magic potion, your secret weapon. It wakes you up in the morning and keeps you awake at night. So why hold back? Unshackle it. Let it fly. Let it dance. Let it bring the rain. Let ambition fuel your next chapter. And let HSBC be your partner in this journey. With our knowledge, our network, our experience, we've seen ambition bear fruit again and again across the world. Connect with us. Ambition is too precious to be bottled up, too powerful to be kept on the bench. It's the magic potion, your secret weapon. It wakes you up in the morning and keeps you awake at night. So why hold back? Unshackle it. Let it fly. Let it dance. Let it bring the rain. Let ambition fuel your next chapter. And let HSBC be your partner in this journey. With our knowledge, our network, our experience, we've seen ambition bear fruit again and again across the world. Connect with us. Ambition is too precious to be bottled up, too powerful to be kept on the bench. It's the magic potion, your secret weapon. It wakes you up in the morning and keeps you awake at night. So why hold back? Unshackle it. Let it fly. Let it dance. Let it bring the rain. Let ambition fuel your next chapter. And let HSBC be your partner in this journey. With our knowledge, our network, our experience, we've seen ambition bear fruit again and again across the world. Connect with us. Ambition is too precious to be bottled up, too powerful to be kept on the bench. It's the magic potion, your secret weapon. It wakes you up in the morning and keeps you awake at night. So why hold back? Unshackle it. Let it fly. Let it dance. Let it bring the rain. Let ambition fuel your next chapter. And let HSBC be your partner in this journey. With our knowledge, our network, our experience, we've seen ambition bear fruit again and again across the world. Connect with us. Ambition is too precious to be bottled up, too powerful to be kept on the bench. It's the magic potion, your secret weapon. It wakes you up in the morning and keeps you awake at night. So why hold back? Unshackle it. Let it fly. Let it dance. Let it bring the rain. Let ambition fuel your next chapter. And let HSBC be your partner in this journey. With our knowledge, our network, our experience, we've seen ambition bear fruit again and again across the world. Connect with us. Ambition is too precious to be bottled up, too powerful to be kept on the bench.
Hello.
It's the magic
All right,
potion,
ladies and gentlemen,
your
you all are
secret
requested.
weapon.
Please get settled. We are starting with the panel discussion very soon. Once again, ladies and gentlemen, please be seated. We are starting with panel discussion soon. Hello. Welcome back, ladies and gentlemen. I really hope the tea or coffee has done its job and we all are super set for the next panel discussion. Are we all ready? Please clap for HSBC once again, everybody. Can we all clap loudly? All right. In a world where global Indians live, work, invest, cross borders, how do we rethink life insurance to match their dynamic lifestyles? Our second panel discussion for today will explore how GIFT City's innovation-friendly framework is redefining life insurance, offering new possibilities for global Indians. To dive into this exciting conversation, I would like to invite once again Mr. Ghosh on stage. Ladies and gentlemen, please put your hands together for him. I'll request him to moderate this panel discussion and take over kindly. Thank you.
So over the last few years, HSBC has been conducting a survey called the Quality of Life Survey, which basically goes across and meets a range of people across demographics from more than 20 countries globally, trying to identify some of the key life goals that people are aiming for, especially in the context of a changing world. And the last Quality of Life survey that we did, there were three key ambitions that came out very, very vividly amongst virtually every segment that we surveyed. These three were, first, interestingly, was physical health, second was mental health, and the third was retirement planning. And all these three have a very, very deep connection with what happened, of course, during COVID and the uncertainty that it brought down to our lives. And I think across age groups, these three principles, these three elements became very, very important. For this round of panel conversation, we really are going to be talking a bit about some of the things that enable us to mitigate the risk arising out of all of these three issues. And to join me on stage at this point in time, I'm very privileged to welcome Salil Bhatnagar, Chief Distribution Officer, Canara HSBC Life. Rishi Mathur, Head of Strategy and Products, Canara HSBC Life. Jugal Kajaria, Director, EY India. And Shri Mahipal Reddy, ED, IFSCA and Head of Insurance. Thank you. Do take your seats, please, gentlemen. Reddy sir, I'll start with you, the regulator. So we will start with you first. So we spoke about investments in the first half of the day, and now it's turn about insurance. We'll start with innovation in insurance. Tell us a bit about what's happening in GIFT. How is GIFT going to be any different than what's happening in India on the insurance industry?
So at the outset, I would like to thank HSBC for...
Just take it slightly closer.
So thank you for having me in this panel. Maybe you wanted to start with innovation itself. So innovation is now the word which is catching up. So what is enabled in the regulations about product innovation? Perhaps we can see it in two ways. One is what is the regulatory environment which is facilitating it, and what is the market responsiveness, or what is the market dynamics which is influencing what is the need for innovation. First of all, IFSCA regulations are principle based. So in the morning, I think we have seen 31 regulations. Out of that, you may be knowing that 13 regulations pertaining to insurance. So in 2021, the first set of regulations came into force. One is registration for insurance companies and registration for intermediary offices. The product pricing and insurance product that came in 2023. If you observe the regulations, firstly, they are principle-based to encourage innovation, that is, keeping in view of ease of doing business. In any product regulations, if you observe in any jurisdiction, there are three types of systems. One is file and use system, wherein the regulated entity will file the products, regulator will go through it, both in terms of policy wordings and pricing, then grant an approval. And it is a time-consuming process. And there is second system called use and file system. To speed up the process, where first you use it and then file it, then you will get it a certification. And third is, of course, prior approval system. So the three types. If you observe IFSCA insurance product pricing regulations, none of the three systems are there. That is beyond this. That is, the flexibility is given to the insurance companies to develop the products based on the board approved policy. And there are certain guidelines given in the regulations. You have to follow 1, 2, 3, 4, 5. So that is the kind of flexibility. So the IFSCA regulated entities can fast respond to the market dynamics. So it is not just ease of doing business, cost of doing business. I think there is a third word. I don't know whether maybe once I use, it will catch up. That is speed of doing business, SOD. So I think this is, we have one more step forward, that is speed of doing business. So that is a regulatory framework. And compared to the domestic regulations, there are certain carve-outs given in the Insurance Act. For example, 64 VB requires that premium has to be received in advance so that to commence the risk. But here in IFSCA, that carve-out is given, premium need not be received in advance. Just to align with the global standards so that we align with the international practices. So these two, I think, will enable. And third, of course, from market side, what is the requirement from market side? How do you react to that? That is the specialized kind of products. Here at IFSCA, if you look at, we cannot look only at traditional products. We have to look beyond traditional products, then only we can respond fast. There is a need for specialized insurance products. If you take it general insurance or life insurance, there is a niche. I mean, the insurance is not just a contract here. Traditionally, the product is considered to be a bilateral contract, but today it is evolving. It is not just like a product, it is a solution. What do you mean by solution? Solution means you have to go beyond that. So there is a value addition to the product. You have to give risk management services, risk mitigation services, loss minimization services, and also be proactive so that the risk itself is minimized. So it is a risk insurance solutions. So that is the market demand. That is why we have to see beyond traditional kind of products. If it comes to the ecosystem here, the banking sector, capital market sector, itself is creating an opportunity for the insurance. So there is a need for bundling the products. The needs of banking sector, capital market sector have to be integrated with insurance. Just to take an example, the insurance bank, these IBUs, they are transacting trade finance, which requires credit insurance. And today it is not just credit insurance requirement. Credit insurance may be traditional, but what is beyond credit insurance is non-payment insurance. It is something like covering a loan default itself, which domestically it is prohibited. And those who are officers here still look at the credit insurance from that perspective. But here they have to see in a different perspective so that non-payment insurance is a different type. This is one kind of example. And similarly, capital market can support other insurance solutions like insurance linked securities. Today, insurance requires heavy capital. Sometimes capital may not be adequate, so you have to go beyond. That is why the risk is transferred to the security market. So insurance linked securities, catastrophic bonds, these are the new type of emerging insurance solutions for which IFSCA is gearing up to enable every insurer to offer this risk solution so that we are aligning to the global standards. So I'm sure that it sets a tone.
No, indeed that does.
Thank you.
Indeed, that does. I think you spoke about pace of execution. You spoke about the innovation that can be brought through with engagement with capital markets and banking and the opportunity build. So, given that we're talking about these innovative products, Rishi, you lead the product function, you lead the strategy function within Canara HSBC Life. So, tell us a bit about what's happening. What is your sense? How does GIFT influence some of the strategy, products marketing functions within the insurance industry at large?
Yeah, so I think overall it's essentially creating an extremely conducive environment. And I think you know, when the industry is actually looking at gift products, it's actually looking at them with a very fresh pair of eyes. It's actually you know, talking about product design or product development in a very different manner, which is not you know, driven purely by the you know, a prescriptive process of regulation, but driven more by, therefore, what is the need? What are the emerging needs that are coming with respect to customers? What are the kind of you know, emerging risk mitigation you know, needs that are there? What are the kind of investment needs that you know, come for a long-term investment that you know, people would like to make? So many new areas are emerging simply because of the fact that the enabling framework is very different, and the enabling framework in IFSCA is not prescriptive, but it is actually you know, actually talking about the fact that given a broad you know, frame of reference, how can we kind of work and design something which is relevant for the customer? And it's I guess it's over a period of time will evolve to be feedback intensive, which means that over a period of time innovation will come, and you know, not everything will be successful, but we will eventually feed it back, and I'm sure the regulator will then appropriately, you know, kind of evolve the regulation to move forward. So I think what's happening is that it's giving a big fillip to innovation. It's giving a big fillip to focusing most of your time and effort in product design and product development, in proposition development, looking at what are the real needs for the customers. So it's actually, you know, giving the time and energy into saying that if we are to look at, you know, a gift customer, and then if you were to look at the same customer, say for example, going to, you know, Hong Kong or a Singapore, and then how can we create in the gift environment a product that actually is, you know, competing, and what are the needs that are specific to, you know, those kind of customers, and therefore can we replicate something which is better, or you know, do a plus on it, or can we find a better solution to the same issue? So you know, and from that is emerging newer and newer you know, kind of innovation and design. So for example, we are you know, looking at now products which can explicitly address, you know, educational you know, requirements. You know, somebody who wants to send his kids abroad, or you know, somebody who already is abroad but is looking to kind of make sure that he has enough protection available, or is looking to protect his parents, you know, who are in India. So taking specific situations, specific needs of non-residents, or you know, even for resident Indians, and how they can be met, is actually a facility which we are only able to kind of bring to the fore by looking at the GIFT framework. And I think that is what we are now you know, working on, and I'm sure we are going to do more as an industry to leverage this this window and this opportunity that we have. I think in conventionally, Shabal, what happens is that when we talk about the insurance industry, we don't easily associate innovation and you know, that kind of a thing with us. But I think that can change, provided the right framework and the environment is available, and we think carefully about what the customer insight is. Then I think there are a lot more opportunities across the insurance spectrum.
That's encouraging. That's encouraging, Rishi. Jugal, like Indians are completely obsessed with the idea of taxation, and insurance, of course, for many years has been a vehicle which enables tax savings, if I could say that. Why don't you give us a bit of a perspective on some of the recent regulations around taxation, especially which came out during the budget, and how does that impact products which come out of GIFT?
Sure. Thanks. First of all, I would just like to thank Canara, HSBC and HSBC for their wealth management platform. I have been speaking with them and they were very, very excited on setting up this entire platform over here. So that's a very good start for the industry. Coming to the tax part of it, so let us first understand what the use case was. The insurance in GIFT City basically is benchmark, and what it is saying is, if a non-resident buys a life product from anybody outside of India, India never has a right of taxation on that income. Now that's the same thing. And that was the major use case which was everybody looking at as NRI and non-resident population to attract in this zone. Because India was getting taxation right, it was becoming a product which was becoming a very tax inefficient product, because otherwise, let's take an example of investment in mutual fund or AIF in GIFT City, which we spoke of, or a bank FD in GIFT City. All of that was perpetually exempt, and a life insurance product was becoming tax inefficient. And sir, therefore, I think what you said was not only on the IFSC regulations, but even on tax part of it, there was a speed of doing business. Because when this was highlighted to IFSCA, IFSCA started working back with the CBDT in a manner such that when the actual life insurance companies have started the operations over here and started issuing the policies over here, the regulations are already in place. So that's the big part of it. Now, what is this change? On the 1st of February 2025, when the finance minister presented, what does a life insurance taxation work? It is very different vis-a-vis other products, because basically they say either exempt or taxable. Life insurance products has 3 or 4 legs. The first one is, in case of a death of a person, there is no tax liability, which continues even for a gift product. So that parity continues. The second limb is that in case of a life insurance product, the total annual premium that should be paid should not be more than 5 lakhs, or approximately $6,000. And in case of ULIP, should not be more than 2.5 lakhs, which is $3,000 approximately. Now, when you breach that, it becomes taxable. Now, the entire population sizing or product sizing which was looked at, these were very, very small amounts. And again, as I mentioned on the use case, did not make a lot of sense. So the biggest change which has been brought in the budget, and now which is an act shortly, is that those limits have been relaxed in respect of policies which are issued by the gift office of a life insurance company, which is a huge difference. I'm not getting into the product side in dollars and all those things. That's the first part of it. The second part is that in case of life product, the premium should be less than 10% of the sum assured. Okay, which in a different sense means that a sum assured should be 10 times of the premium at any point in a year or during the life of the policy. That limitation continues. So the life insurance companies, when they're driving their products, they will have to adhere to this limitation, and I think they've developed their products also in that fashion in the past, wherein they will continue the same limitation, restriction, or regulatory aspect even in the gift city zone. That's one. The other thing I just wanted to call out, because when life insurance products come out, they will tend to cover all products. But there will be annuity products, group products, pension products. Currently, they are not covered within the ambit of the exemption. As and when these products start coming up from the gift city, there will have to be a use case made to the government and the Ministry of Finance to grant a relaxation. That is broadly the summary of how these regulations have come in.
Thanks, Jugal. We, of course, will come back to you with some more questions on taxation. Salil, unit-linked products. You are a specialist. We've been doing this for a long time. Tell us the difference between having unit-linked products available in gift vis-a-vis in domestic India.
So thanks, Shaibal. I think this is a very pertinent question, I would say, because why gift? Why should I buy through gift? And one thing which Mr. Reddy also said, that we are looking at this from the customer lens. How can we create a customer-centric solution? So if I look at what the customers were saying when we were meeting them across markets within India or even outside, one thing which they were saying is that if I'm sending my child abroad, what I'm looking at is I should not be, having the currency risk. If today I invest in plan, then I actually have a currency risk, because if I invest in a rupee denominated policy and I save some money over time,
And whenever I get that money, that may be sufficient or may be insufficient. Is there a way for me to eliminate this currency risk? That was a customer perspective. The second thing was that we all have seen dollar appreciating. How I, as a customer, could actually look at gaining that advantage of dollar appreciation if I'm able to invest in a dollar-denominated policy. Now, from a customer lens, these were the key asks which are there, which unfortunately were not there in a domestic product. They are great products. People have been buying. They've been leveraging the markets and getting the growth. And the third and the most important also was that people are looking at external markets. They want to invest outside India. Like in the earlier panel also, we were deliberating that, emerging markets, people again having a fund which is investing back into India, does it really make sense? Because I'm already investing there. So if I'm getting an exposure to an external market, which offers opportunity for growth, how do I do that? And the good news is that through the gift structure, one is able to actually offer a product, one, which is dollar denominated. It provides you to save, invest and save over time, over the long term, for any planned liability in dollars. You get the currency gain also, because if rupee depreciates over time, I'm a beneficiary in that sense. And last but not the least, if worst was to happen, because people always look at scenarios, what if something goes wrong? I have a dream to send my child abroad. And we see increasingly that trend that people are wanting to send their children abroad and they want them to study at a particular university, which comes at a cost. Is there a way for me to ensure that whatever happens, that dream comes true? How can that happen? Those are some of the asks which were there from the customer side, and that's exactly what the gift ULIP enables you to do. It enables you to leverage the foreign markets from a return standpoint. It enables you to create a dollar-denominated policy which insulates you from the currency risk. You are kind of insulated from that. And last but not the least, it ensures that whatever dreams you have for your children, they do come true. There is no compromise there. So from that perspective, I personally feel this is truly a win-win proposition.
Sure, thanks, Salil. Jugal, NRI customers, and we spoke about this again earlier, are a very core part of our customer base. I think we understand NRIs very well. We are a global bank, but we also manage a large set of domestic customers, and we see the opportunity in India growing very, very fast. So when you look at taxation, how are the taxations different for non-resident Indians investing in an insurance product in GIFT vis-a-vis a domestic Indian investing in GIFT?
Sure. By the time I complete the answer, I think I will become quite popular, because the point is, when it comes to the entire GIFT City ecosystem, the entire tax exemption is largely linked to the non-resident. And I'll tell you why, because the entire concept is basically they wanted the onshoring of the offshore business. And I explained the use case in terms of how this was developed between a non-resident buying a life product from an overseas entity. And to that extent, even as I think Keyur also mentioned in the previous panel, there was no discussion of an Indian resident getting any kind of a tax benefit. But when it came to the Income Tax Act and the Finance Bill, when the bill got issued on the 1st of February, they said in the memorandum that it is limited or restricted only for non-residents. However, when the text of or the fine print of the regulation or the Income Tax Act was out, the word non-resident was missing. And this law has got passed by the parliament, which naturally means that a life product which is issued to a resident or to a non-resident will have a like treatment in terms of the exemption being available. This is the current position as per the act which has just got passed.
So it's beneficial, right? So it's
absolutely, yeah.
Super. Jewel, that's good news. Salil, product construct, ULIPs, of course, have been in India for a while. It has developed and evolved, if I could say that, over the last 2 decades now. And customers, of course, have multiple options when they're investing in ULIPs. How does this pan out for a gift product? Are there similar kind of opportunities available? Are they different? Are they better?
Thanks, Shaival. A very interesting question here because I'll pick up on the theme of innovation that my friend Rishi was talking about and Mr. Reddy mentioned. And the whole ecosystem which has been created in GIFT, I would say, is a very enabling environment where you have the opportunity to really innovate. Now, from a customer standpoint, what people have been saying is that, I'm planning for the future. I'm planning to mitigate the risk. God forbid, if the worst was to happen, at least that risk should be mitigated. And if that happens early, and I'm not in a position to really pay the future premiums, or my family is not in a position to pay the future premiums, they don't want to really compromise on the dream. I still want that child to actually go to that university abroad, whether I'm around or I'm not around. Now, there is a very good concept called a waiver of premium. So where, if something worse was to happen, the future premiums are waived off or paid by or contributed by the insurer, and whatever is the defined policy value, depending obviously on the market returns, because it's a unit-linked plan, which generates market-linked returns, it grows. So if the worst was to happen, now those features are elements which are integrated in the GIFT product. The second thing which people have been often saying is that if suppose this was not happening, if the risk doesn't happen, I am paying a mortality cost on the plan while my objective was to invest and save money over time. And if the risk has not happened, why should I really pay for it? Now this I'm sharing a customer perspective. The beauty is that in case the risk doesn't happen, you have the best of both worlds, which means that your mortality is refunded, which is again an innovation which enables the person to actually leverage this as an investment plan. If you stay long term, risk happens, it is covered. Worse was to happen, it is covered. If risk doesn't happen, the mortality which is charged to your product is refunded. The next, which I think ask which people had was that over time my liabilities may go up or down. I should have the flexibility to increase my risk cover or decrease my risk cover. When I increase my risk cover, if my liabilities have increased, if I'm planning now to send my second child also abroad, I would like this sum assured to be actually, or risk cover to be, increased. That flexibility should be there. And I'm happy to share that the regulations are enabling and the products being structured are having these elements built in. And if at all I'm at a life situation over time, because these are long-term contracts over the next 20, 25, 30 years, I've saved enough money, it has generated a huge corpus. I don't need that risk cover now. I don't want that to be eating in terms of cost into the fund, and therefore I have the flexibility to even reduce the cover. Obviously within the given tax limits of 10 times, but having said that, these flexibilities are there. And last but not the least, as an investor, if I have additional cash which I would like to invest, and I want to save in $1, I should have that option to top up. Now these are asks which are coming from the customer, and truly because these are plans within GIFT which are being structured keeping the customers in mind, I'm happy to share that these are elements which are brought into the GIFT plan. And that's what stands out, which is, it's a truly win-win from a customer standpoint. And very interesting times ahead, I would say.
Sure, thanks, Salil. Since you're talking about ULIPs, Rishi, investment, the investment strategy, of course, is a very large role to play in how ULIP returns eventually return funds back to its customers. Tell us a bit about what is the plan in GIFT. What kind of investment strategy are we playing out for the product that you're launching here?
Right. I think for the industry as a whole, on ULIP investment strategies, there is a wider play. There's a wider scheme or field of play that is available. I think because we are not working with a very specified rules on this, while there are again a certain frame, but then the opportunity here is wider. You could look at fund of funds. You could look at even funds which are exchange traded. You could look at going forward feeders or whichever way you would kind of want to do that. In fact, the right way to think about what investment options are available would be to say, for example, go to a Singapore or a Hong Kong product, which is a typical what you call an ILIP or an investment linked product, and there you would find that it's essentially a combination of two parts, right? I mean, obviously the insurance product, and then a whole host of funds which are provided by a large set of asset managers or providers, right? While that is something which is not happening right now, but I'm saying that this is the evolution. Eventually, there will be a much larger variety of investment strategies that could be available in gift ULIPs. There could be some interesting options in terms of looking at, not just debt, equity and combinations, but, could be commodities, could be other areas which are in many cases maybe even more relevant to, NRIs and all of that. For example, could be a precious metals or anything like that. But yes, these are all some of the thoughts that are already there in the industry. As we will see new products and investment strategies, kind of play out, I think the regulatory environment is enabling it. And so it's a very exciting space. We would see a larger set of investment strategies play out. And as I mentioned in my previous part, I think with the right support, it could actually be things which are more niche and more relevant to customers who want to kind of customize it, who want to make it more specific to what they would want. And then, of course, there are other areas which, of course, are important. When you're looking at a large investment, how it kind of moves. Are you making sure that you're protecting yourself in the very end? Because if you're doing a goal-based investment, then when you come towards the end, you don't want the volatility. You want the volatility to kind of get suppressed. And if you want that to happen on its own. So, some of these things are easier enabled in gift products, for example. And there are many more flexibilities which are therefore available, and I'm sure the innovation industry will surely bring in some of these features. So it's exciting times. I would see a lot more investment strategies play out in ULIPs, which would be sold through them.
Sure. Thanks, Rishi. Salil, we spoke about regulatory filing, ease of execution. We spoke about product structures, taxation. I think one thing which is slightly unsavory but is a key to any insurance product is claim settlement. So share with us from a India point of view, where obviously CHL, Canada HSBC prides itself on its claim settlement ratio, but India, of course, is a fairly evolved market in that sense. GIFT is new. What is the process here? How does it really work? How confident you are that you'll be able to deliver the same kind of efficiency that you have in onshore India?
I think a very pertinent question, because the real moment of truth for any insurer is really when the unfortunate claim was to happen. And we all learned that the hard way during COVID. Vis-a-vis a normal year, during the COVID times, we saw almost a 300% jump in the claim ratios or claim rates. And one fundamental learning was, I think that was the time which was really to stand up and deliver, which we did. And I'm very happy to share that from a process standpoint, within the gift space also, we are committed to having a similar structure from a claim settlement standpoint. There is a dedicated team which will be actually working on this from the intimation to the ultimate settlement. Because what is often tedious in any unfortunate claim is the whole process of completing the documentation. One of the things which we take pride as Canara HSBC Life, which we did almost a decade back, was the fact of paying the fund value on claim intimation, which is your money I'm managing, I'm just paying out. If your sum assured or the death benefit, unfortunate death benefit is higher than the fund value, the balance can follow, but at least I'll pay that. So now those are the elements which were the industry first that time and really resonated with clients, because that was the real time when they needed the money to come in. So from a claim standpoint, we'll continue to have those standards in terms of delivery. The second thing which is very important, for while the claims may or may not happen, but what is important is that you plan well ahead from a governance standpoint, which is the whole sales process is such where the adequate disclosures are there at the solicitation stage, which means that if everything has been disclosed, the claims are necessarily paid. Which means, and I'm very proud to say that at HSBC we have a 100% claim payout ratio, which means all claims intimated are paid out, which is very important. So from a process standpoint, the same standards apply. There's a dedicated team which will be working on this to ensure that the customer is, or the customer's family is supported in terms of completing the documentation requirements, and those standards are, lived up to.
That's very reassuring. Thanks, Salil. Reddy sir, even before we come up here, we're talking about digital and talking about how digital infrastructure could enable things in GIFT City. Your thoughts around what is IFSCA doing, and then what role is digital infrastructure playing in easing out the insurance platform inside GIFT?
Yes, digital transformation is the next way forward. Now, traditionally in insurance, the ability or appetite for technology is confined to its back-end operations. Now, in the modern world, it cannot ignore the digital transformation, not only for the back-end operations, but for the tech-enabled distribution. Now, distribution is the key for bringing this transformation. Like a customer journey in insurance, somewhere requires physical approach. So it has been physical approach plus phygital approach. Now, given the nature of business here at GIFT IFSC, the business is cross-border business. So you'll have to distinguish the way we are doing it domestic versus here. So tech-enabled distribution is very important. Like, you have to start with onboarding the customer with the CKYC norms. Secondly, AI-driven underwriting. And after that, claim settlement has to be speeded up with technology. So these are some of the aspects which drives digital transformation. And especially the distribution cost can be reduced only with the technology. So there is a cost advantage. At the same time, speed of doing business is possible. And also reaching out nook and corner of the globe, that is possible only through technology. So you have to see in a different perspective. It cannot be just same traditional way of doing things. It has to be very sophisticated way of looking at things. So digital transformation is not just on the insurance purchase, like even back office, maintenance of records, policy document management, all that will be digitized. And IFSC has been encouraging the fintechs and insurtech environment in the form of sandbags. Already the sandbags regulations enable anybody to come and experiment the way they want to experiment in the form of distribution as well as any other way. So I think the insurtech will play an important role in the coming. So for insurtechs, I think there is an enabled environment. So we have to see how digital transformation will take to the next step. So I think from regulator side, the preferred way of doing business is through technology.
So thanks, Reddy sir. I think IFSC in many ways has been the forefront of using technology for front-end engagement with the clients. And like you said, I think traditionally digitization from an insurance point of view has always been about back-end operations and at best underwriting and not really beyond that. You're basically saying that needs to get extended to distribution, claim settlement, and so on and so forth. And IFSC, as usual, will be expected to be really at the edge of that change. Again, Reddy sir, we were talking about this earlier. I think as a global bank, one of the things that our customers, especially those who are banking with us in other countries, come back to us as feedback on is our innovative product ideas like jumbo insurance, leveraged insurance products, and so on and so forth. Is IFSC open to explore these opportunities? Are there other ideas that you have at this point in time which we should look forward to?
Yes, definitely this is a future. Maybe we are going into the future. Definitely we have to enable it. Otherwise the portability is the key. Otherwise who will come and invest here? So you need to provide a flexibility for the portability, how it can happen. Of course, there is an ecosystem around it. It is not just about we can enable it. There are other authorities which should also be impressed upon. For example, the tax structure. So here and there, And if it is in between, what is a tax advantage they are taking or what is a tax loss here? So I think one of the environment is tax. Second is repatriation rules. So we should see country to country it differs. So the repatriation rules is another system in the ECO. And third, I think it is more on the way the NRIs want, how they wanted to take it back or repatriate. So the individual preferences. So only through brainstorming, having interaction with NRIs and their future needs, we will come to know. And from insurance company's side, there are 2-3 ways to do that. Despite this ecosystem, if it supports, one is here at GIFT IFSC, you have the integrated advantage. Like you have insurance company, you have reinsurance company at the same place. So reinsurers can support how to seed this from one company to other. And there is one methodology called novation, by which the new insurer with consent and agreement from the previous insurer can port it. So that is one way. So these are some ways. But however, this is subjected to the tax regime, repatriation rules. So that we have to see. I think from our side, I think we can push it as and when the requirement comes. But first of all, you have to start, then see the experience, and depending upon the journey, definitely IFSCA is proactive to enable it.
Well, thank you. That's very encouraging. I'm sure Rishi and Salil here would take that back, and we've been talking about this, so you might see a proposal from us coming in very soon. Jugal, everything somehow finally ends up in taxation. So the second last question for the panel for the evening, regulatory nuances, especially from an insurance point of view to residents, non-residents. Is there anything that you think we should highlight out? Any thoughts that you would want to share on this?
Yeah, 2-3 aspects on this. First, look at the insurance company and the manufacturer of the product. Now, when it comes to people who are residents in India, they are not allowed under the LRS route to take any life product from a life insurer outside of India. So that continues. What has been done is that LRS has got opened up only for life products being issued by gift offices of insurance companies. To that extent, people who are interested in doing dollar products, which are residents like us, this provides a natural arbitrage for an Indian insurance company, because other foreign life insurance companies are not allowed to do that. So that's the first part. Second, let's speak of first the non-resident putting in the money or buying life products. When they are making that money, and we have a lot of non-residents outside of India, they regularly keep on passing the money back into India through remittances. What we have spoken with a lot of countries, there are no capital account limitation in terms of their movement of the cash back to India. So those same principles are going to apply to them. So to that extent, non-residents can put in their money over here. The second category of people is going to be residents who want to invest in the gift products of the insurance or the life products issued by the IIOs. There, they will have an annual limit of US dollar $250,000 per financial year. Now, it is per financial year per individual. So a family of 4, effectively it means $1 million of cash in terms of life products can be moved out. These are the two things. One thing I thought we'll call out, because this is which is very clear in the law, but it's not called out so much, is there are many people who have earned a lot of money and they come back to India. When they come back to India, their residential status becomes resident. So they are not subject to LRS limits in respect of money which is continued to be kept outside of India. So those money, without the LRS limits of $250,000, without the applicability of TCS of 20%, can be used for buying the gift products, because it is in a zone which is full of not subject to capital account convertibility. I think these are 3 or 4 major parameters or pillars in terms of the regulatory aspects.
Thanks, Jugal, for that context. So.
There is another way. For example, where there are majority of policies with foreign insurer, and many of the customers are interested to come here, they can set up a branch office here And business transfer can happen subjected to the other conditions like tax and other
Absolutely,
rules. So you can impress upon that foreign insurer. Maybe already there are a few branches in the Middle East where substantial policy holders are NRIs. So if they are interested, they can impress upon them to open office here.
CHL obviously has a branch office here now. Sorry, Sal, you something add something.
Yeah, you're absolutely right. We already have, we're fortunate to have a branch license already, and we will be, the moment we have the enhancement from a corporate agency standpoint for the bank, we will be launching it soon. But just to your point, I think this is a very interesting point because apart from obviously the needs that we spoke about earlier, one of the key needs is also estate planning, succession planning and legacy planning. And what we are seeing increasingly, what customers tell, where the children are going abroad to study, somehow they're settling there. They don't want to come back. And therefore, what people are looking at is creating a dollar-denominated estate over time, which can be easily transferred. So one, you get growth. Two, it's easily transferable. And if the child decides to settle abroad, at least you have a dollar estate, which the child inherits, and therefore it adds value, rather than going through the whole process of transferring funds through other means. So from a customer standpoint, even that kind of emerges as a key need from a estate planning and legacy planning perspective.
Thanks, Salil. Rishi, last question for the evening. We spoke about reinsurance, and Reddy sir spoke about one of the advantages of GIFT is that you got the insurance team and the reinsurance agency right there inside the geographical territory of GIFT. How do you see that playing out? Do you see reinsurance being the IFSC or the GIFT area being and the reinsurance being available there to be a key differentiator, and how does CHL intends to play that out?
Yeah, I think that's a very relevant point. As we talk about protection, and then we talk about protection at the scale we are, talking about for large customers, and we talked a bit about jumbo policies, which is essentially a very large cover, particularly for, ultra high net worth customers. So I think that's another area where reinsurance comes in. Even for regular business, insurers and reinsurers are kind of bound at the hip. I mean, at the end of the day, we have to work together to kind of, as an ecosystem, to kind of, work on managing the risk correctly. Because, it's a way of allocating the right capital to the right place, at the right pooling station, so as to say. So that is where the ecosystem of reinsurers and insurers is very important. And I think given the GIFT ecosystem is available with all of the advantages that it has, I am quite sure that this ecosystem of insurer and reinsurer will also kind of evolve here. I think as more and more insurers are coming into GIFT, I think the reinsurers are already, many of the reinsurers already have offices here. So there will be opportunities to retain and seed risks within this whole ecosystem. And what that will help from a customer perspective is that it will allow insurers to offer some of these kind of products, or where risks are shared, and therefore you have an ecosystem which is able to kind of take care of all of the risks available. I think there will be some of the tax implications and all of that. I can see Jugal smiling about it, but yes, they will, once we solve them out, and with the help of the enabling regulatory framework, I think this ecosystem will definitely evolve. So already there is enough engagement with the current branch offices of reinsurers in India, which insurers who are making GIFT products are looking for reinsurance on that. But as the ecosystem comes within GIFT, I think it will become much more easier. It will become a more enabling process which will kind of work, and then I think frankly there will be no difference between, say for example, a reinsurance market that's operating in Singapore or versus what's operating in GIFT. So I really see that happening not too far away in the future.
Sure. Thanks, Rishi, and thanks, gentlemen. Obviously, another insightful conversation. And hopefully we'll get to talk more and discuss more interesting things, especially on the product side in the coming few months, if not weeks. So thank you for joining us for this evening. And with that, I think we come to the end of this panel conversation. Really appreciate you spending time with us. Thank you.
Thank you so much, Mr. Ghosh and all other panelists. Once again, ladies and gentlemen, please put your hands together for all of them for such a power-packed panel discussion. And now I'll request Mr. Ghosh to present the memento to all the panelists. Thank you so much. All right, ladies and gentlemen, so that brings a close to HSBC Presents HSBC IFSCA Global Wealth Summit. Big thanks to all of you for being such a wonderful audience. Please clap for yourself today. Before we continue,